Taking Tuesday a little quieter, Wednesday feels potentially even quieter than that. So here we go. Let's show you some numbers, give you an idea of what is going on. How far will today's session take us? Well, as you can see, the FTSE 100 barely budging. No movement there to see at all. Consolidation appears to be the operative word here. Stock 600 expected to go nowhere in a hurry either. And there you go. That is what we are seeing on the screen in front of us. We are after the huge story of Monday. The session on Monday was just epic. And then we get Tuesday a little quieter, Wednesday a little quieter, and that seems to be the theme. As Mark Hudman was saying just a moment ago, where does the next catalyst come from? In many ways, it wasn't CPI. Does it come with the data out of the United States a little later on this week? I don't necessarily know, Critty. What are you seeing below the surface?
It's interesting. It's kind of a tale of two tech stories, and I think that's what's driving the market, both to the upside and the downside when you look at some of these movers and how this is all shaking out. But look, we are still waiting. I think the key word is waiting for things to shake out. I'm seeing 292 stocks in the green, 219 in the red, and 91 that are unchanged, that have no direction at all. And I think that red and the green, the Christmas basically that you're seeing on your screen tells you everything.
Yeah, Christmas in May. It's an odd world. But yes, in terms of looking for the next catalyst, I mean, we've been so focused on all the headlines coming out of the White House, rightly around trade. Is the next catalyst perhaps in the hands of the Kremlin? We still have not heard from Putin as to whether he is planning tomorrow to be in Turkey. And that obviously would be a big market moving, or market focus at least, with the potential to move markets depending on what we're agreed there. In terms of the individual sectors then that we're watching this morning, I'm looking at to see if we get any weakness in travel and leisure as a result of that chewy line. Not any yet, because that's the best performing sector. It has to be said it's more to do with the leisure side than the travel side right now. But we'll see whether that chewy statement has any impact. But that share is not open. That share price is not open. Nor is Burberry. Nor is Hapag-Lloyd on my screen. So there we are.
So all the
nearly 2 minutes in, and we can't tell you how they're trading yet.
No, but we can tell you how Alstom is trading, and that was one that Joe had watched, beating this morning, down about 10% on that French stock.
Absolutely getting whacked this morning. Shares down really, really hard. One of the biggest drops that we are seeing around Euro. Cash flow was a factor. Looks like the margin guidance story is a factor there as well. So an industrial company that certainly is feeling the story of the global slowdown, maybe. It's talking about a 2026 adjusted EBIT margin of around 7%. That's a little softer than anticipated. So the market really punishing this story this morning. So interesting, we are getting some single stories that are moving in terms of kind of what's happening with Burberry, what's happening with Bilfinger, what's happening with these other stock stories. In a market that's not doing much, it's going to be interesting because actually you'll be able to see maybe a more accurate reflection of what the single stock is doing in a market that's not overall doing anything else.
Yeah, we're certainly not dominated by one trade narrative. We've had a lot of headlines out of Saudi Arabia. We continue to watch, and we should mention that President Trump and Mohammed bin Salman are expected to speak again this morning, imminently. Yeah. So we'll certainly be back there, and our focus will be taken there. But in the meantime, yes, some of those individual stories cutting through. TUI down by 6%, for example, this morning.
Absolutely. Well, I feel like we're maybe waiting for some guidance, some direction from these markets. In the meantime, let's get some analysis from a true expert around our table. Fabiana Fideli joins us, CIO for Equities and Multi-Asset and Sustainability over at M&G Investments. Pleasure to have you on the program. Thank you so much for coming in and joining us this morning. Guy made a crucial point in our interview with Hapag-Lloyd in the last hour, which is simply that we're in a stop and start environment because we don't know what the tariff story looks like, what federal contracts look like, what spending looks like from really anywhere except for maybe Germany. And even that is raising some eyebrows. Walk us through how you price that in to this market.
So, Critty, good morning. I think the U.S. administration has made a pivot in its policy. If you remember, weeks ago we were talking about we really don't know where this is going. It could be more tariffs or there are going to be negotiations. There is a feeling that the policy is starting to change, that actually the tariff narrative is mitigating. That is a positive. Whether this is because of the administration being concerned about what happened, for example, at the long end of the U.S. Treasury curve, possibly less so in equities at the beginning of April, or whether it was part of a big plan, right? Go in, shock and awe, create confusion, and then start negotiating. Something is happening, is giving the market more visibility, which is what you're seeing right now in equity markets. And also you're seeing it at the long end of the Treasury curve, where there is some kind of normalization, and in credit markets.
Do you buy risk assets on this thaw?
So we have been buying risk assets, but as we've said before, when you have uncertainty on the macro side, you really have to point to the micro. So you have to really be very idiosyncratic on the stories that you're buying. And Anna, you were talking about very different earnings releases, very different discussions, company by company. We've seen this over the last few earnings releases, and even more so now. And by the way, we're seeing it not only in the US, but across the world.
I was looking at some research on that subject of the earnings story. I was looking at some research by Morgan Stanley that pointed to an increasing number of companies citing pricing power as one of the ways they plan to get through this, which sounds good for margins and bad for CPI if you don't want CPI to go much higher. So do you see that, Fabiana? Is that a big theme coming out of this, that companies are once again, just like we saw in the early days of COVID, talking about their pricing power?
Absolutely, and that is very important when you choose a company to invest in. It's not only pricing power. The pricing power comes, for example, from the ability to innovate in line with what your consumers require, and there are companies that are able to do that. To your point, however, this also would mean more inflation if some of these companies were able to pass on those increased costs onto their consumers. So tariffs and a mitigation of what we're seeing right now on tariffs are really important for the economy.
And so you see US businesses that are very well worth still investing in, don't you, Fabiana? Because, yes you think that, okay, so US exceptionalism may be changing, evolving, but I think one of the notes that stood out to me, empires don't fall in one day. Yes, diversify, but don't divest from the US.
There is no other alternative to the US. I mean, the US exception is true and is very clear when it comes to innovation, it comes to entrepreneurship, it comes to very deep capital market. But the US is not the only game in town. There are other areas where you can invest. I mean, Europe has a lot of good opportunities. Asia has a lot of good opportunities. But what we've seen in the US was that there was a sell-off in technology, which was unwarranted. I mean, not only technology stocks are the same. So actually in our strategies, we have started buying into technology stocks when we saw the big sell-off.
Do I buy dips still?
You buy dips, but you don't buy them everywhere. You buy dips where you have conviction that the fundamental story is still there. So, for example,
United States. Do I buy dips in the United States?
For example, we bought the dip in AI-focused semiconductors because we felt that that story was still intact.
How much of a headwind for European investors investing into the United States will be a weaker dollar? Do you anticipate a weaker dollar?
So it's interesting. If you think about the dollar, it has reset over the last 5 years, right? It was weaker during the preceding period against the pound or against the euro. So we've had a reset and a stronger dollar. It could weaken to some extent, but I think that story is really going to be related to what happens with tariffs on the shorter term.
But how big an impact is it going to have in terms of my investment returns? The Nasdaq is now only down by 1.5%. Year to date, I think, for a euro investor, still down nearly 10%. How big a factor is that going to be?
It will depend on how the equity market and the treasury market is going to perform, because the moves in the dollar, while they're surprising, they're not huge, right? They can be offset by equity market gains and gains in the treasury side.
So you're going to get more upside in the US, even taking out the dollar trade, even if the dollar's negative. I'm still going to be better off in the US.
No, that is not what I'm saying. Because, for example, in most of our multi-asset strategies, we are underweight the US.
Okay.
But we still find interesting pockets there. So we shouldn't just give up on the US market. But clients are diversifying. When I talk to clients, they're talking more about Europe. They're talking more about Asia.
So when you say you're underweight the U.S. relative to the rest of the world, I'm going to ask the opposite question that Guy did. He said, do you buy the dips? Do you sell the rips then when you start to see rallies like today's?
We have been very idiosyncratic in our moves. I mean, we've seen some companies that have performed very well early in the whole tariff debacle, and we have taken some profit from those companies to reinvest in areas where we thought that the dip was unwarranted. So there has been a bit of recycling of our assets in areas that we thought, this is a good time to go in. Possibly in the past they were too expensive.
Where does this leave European stocks for you, Fabiana? We've talked quite a lot about US tech, and I was reading a piece earlier this morning that suggested everyone's been so busy buying European stocks this quarter that maybe they've been missing that US rally. You clearly not then, if you've been using the opportunity to buy the dips in US stocks. But what's the balance into Europe at this point?
We still like Europe, and by the way, it does feel that over the longer term, some of that overweight that we had in the U.S. is going to move towards Europe. I mean, clients are asking more and more about Europe. Clients are moving money to Europe. Again, there is a lot that is going for Europe. It's not true for every country, every stock. But if you think about what is happening with defense spending, which clearly can permeate more than one sector, if you think about the infrastructure package in Germany, potentially a peace in Ukraine could be a positive, right? Particularly for gas prices. And then last but not least, let's not forget the Draghi report that was requiring or asking Europe to improve the efficiency of its industry, to cut bureaucracy, to cut red tape. Possibly Trump is going to do that for Europe because Europe has to find a way to make its industry more competitive now.
Let's hope you're right. And whatever the force that drives that, it is definitely required. Fabiana, thank you very much indeed. Nice to see you. Fabiana Fedeli, CIO for Equities and Multi-Asset and Sustainability at M&G Investments. The Core 6 looks a little bit like this morning. Let's show you some numbers, give you an idea of what is going on. It is a game of two halves. Well, slightly biased one way or the other, but actually we're not seeing huge movements for any of these stocks. As you can see, luxuries are down pretty hard this morning. LVMH under a little bit of pressure. Burberry's not. Burberry's having a very good day. There's an interesting article in the FT this morning talking about LVMH, or at least its drinks business. Novo Nordisk's a little soft as well, down by 0.6%, but not huge moves in any of the major stocks that we are watching. Let's see what else is going on, because there are some huge moves elsewhere, Joe Easton.
So one huge move, Guy, over in France, turning into a really rough day for Alstom, the French train company. Now, the cash flow weak, once again, missing expectations, and no dividend. Those seems to be some of the key lines coming out of that statement. The actual order backlog, as we said earlier, looked pretty decent. Traders telling me, though, it is the cash flow that looks weak, though. Even that move, they're down almost 15%, surprising some people given the calls we saw pre-market. So really the biggest move we've got today. Then another one looking weak is over in travel. We've got TUI, the company, warning of some slower than expected bookings, potentially a little bit of that due to the timing of Easter, according to the statement, but doesn't seem to just be a timing effect, because we're seeing that stock down almost 7% on the German market. The underlying loss also does look to be potentially a bit better than expected, but actually mainly we are seeing weakness across that one today. Then in terms of Allcon, this is over in the eye care and also some of the other medical tech parts of the pharma market as well. Weakness after the close of trading yesterday. That's a big firm, about a 30 billion market cap over in Switzerland, much weaker than expected in terms of the quarterly results. So Allcon really leading losses among the medical tech firms today. A bit of a weak one for us this morning. Then another one, lots of red today. Pretty much all the stocks we're picking out actually declining. Imperial Brands, one of the biggest weights on the FTSE 100, missing estimates once again. The second weak report in just a few months from that company. A lot of focus, of course, on the vaping market and also potentially the regulatory changes here in the UK. And potentially that is weighing on that in terms of the profit miss. So Imperial Brands, a big weight on the FTSE, as I say. Imperial dropping at around 7% this morning. Then finally, a couple of green bits for you. Hapag-Lloyd, the CEO, earlier talking about potentially a boost in volumes in the past few days, given the update in terms of the US trading. Potentially that is actually making up for that miss on the margins that we've got down the bottom of the screen there. Potentially just a bit of a rebound for Hapag today. And then Burberry, probably the best day we've had for Burberry for a while. A bit of positivity finally for Burberry, seeing that stock gaining 8% today. That's despite Chinese sales down 15% or more in the last quarter. As we can see, the bottom there, the sales down yet again, but not by as much as expected. So it's a rebound story with the stock down around 50% over the past 2 years. So Burberry rising in London following a positive update in the luxury space.
Thanks very much, Joe. Joe Easton from our equities team with the rundown of those stocks on the move. He was mentioning Hapag-Lloyd, and we did speak to the CEO earlier. Really interesting conversation around the amount of visibility, limited visibility he can see. It's just as the rest of us are dealing with limited visibility when it comes to tariffs and trade. I was interested in what he said about surging bookings, though, coming back. So just days after we saw that meeting in Geneva taking place, that's already evident in the very high-frequency, real-time bookings data that they're looking at.
It's interesting. We just put bigger ships on. Seems to be the answer.
Yeah. What levers can you pull? Well, we can move big ships and small ships around.
Presumably they don't move that fast. This takes a while to get things moving. So I wonder how quickly the environment will adapt, and whether the early kind of surge that you see has to wait a while, because actually the small ships are still largely scheduled and the bigger ships are on their way. Anyway, be interesting to see how long that takes.
But that's not really there. Even in that mechanism, that's really not tackling the problem, which is that you can have a ship en route and then the tariff thing can change, and then you get to the port and you're charged a different rate. So to your point, that doesn't really work to the same extent.
But in theory, aren't we now in an environment where we've got 3 months, 90 days effectively, in which everybody seems to be like, right, if we want to get into the United States, now is our window. We don't know what's going to happen after that. Go.
Yeah, so he's anticipating a big surge, I suppose, in the short term. And then even if we're back to higher tariffs at some point, who knows? I suppose it's damage limitation. You operate with the levers you can pull, and if these are the few levers you can pull. I thought it was interesting you asked him about the Red Sea, Critty, and he was saying, yes, you're giving us analysis of the geopolitics, just as every boss in the shipping industry will be doing, but also sketching out how long it will take for that traffic to come back, even when you make the decision, yes, we'll go through there again. It's not day two, you're back. It takes a while to build up.
And it was also the same 60 to 90 day time frame. So that's what we're talking about here. I think if you're this is what I'm trying to work out, is that when you have all of these kind of changes that are happening, how do you price it into this market? If you're a stock picker, how do you say, I want exposure to this? And I think, this is what I think about at night when I can't sleep, which is I think you
on this shift, quite common,
right? You have to, especially on the Sunday scaries. But I think it's really important that you look at companies that have way more liquidity, way more flexibility, and a lot more companies do because they've had to do it post-COVID. So are those the companies then that you expose yourself to? I don't know.
Yeah, maybe. Interesting. I'm just captivated by the idea of sleep now. I find it all too easy to sleep, which is strange. Right, 16 minutes past 8 here in London. Coming up on the programme, Burberry shares surge as the company says it plans to cut up to 18% of its workforce. We'll dig into the luxury company's earnings next. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Up to the minute geopolitical news wherever and whenever it happens. I'm Anne Ruhordern in Buenos Aires, Argentina, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It'll be very exciting to have autonomous vehicles here in the kingdom.
Indeed.
If you're amenable.
You heard it here from Elon. He's bringing his robo-taxi to the kingdom.
Yeah.
He has another announcement that he's going to share.
Exactly. So, and I'd also like to thank the kingdom for approving Starlink for maritime and aviation use.
That was, of course, Elon Musk, the Tesla CEO, the CEO of many things, speaking at the Saudi US Investment Forum, which is taking place in Riyadh. It's interesting, from a technology point of view, the Gulf is actually seen as being quite a positive operating environment. Many of the technology companies, you see this with drone technology, you see this with autonomous flying, autonomous driving, low regulation environments, relatively easy to navigate kind of spaces. And it's seen as, in some ways, as an easy place to start off delivering some of this technology rather than highly regulated places like Europe and parts of the United States as well. So in some ways, it's an obvious trade for Elon Musk to make.
But that was fascinating because he's making those comments also in light of Donald Trump and the U.S. administration raising some of the limits in terms of getting chip technology, military technology to a part of the world that has long been a consumer of American defense, but is also not gotten the full access that I think perhaps other allies like Europe, for example, has gotten.
And we're waiting then for news flow surrounding access to NVIDIA chips, AMD chips for Saudi Arabia and the UAE. We should say we're waiting for a press event to take place, basically, between President Trump and Mohammed bin Salman of Saudi Arabia. So when we see that, we will be bringing that to you. So we're waiting for that. There was plenty said yesterday, and there were plenty of US executives in the rooms of Saudi Arabia to listen to all of this narrative, co-investment, one to the other. I mean, Musk was there. We have Jensen Huang was there, Larry Fink, Steve Schwarzman, Jane Fraser, many titans of Wall Street and US business in the room to see what they can lend to this sort of US Saudi push.
Lend from it or take from it? The numbers are pretty big, and there's obviously business to be done, and Trump is spearheading that, and as a result of which, they're very happily, I suspect, very happy to tag along. I'm trying to think if there's a sort of tagline that I can use to get into Burberry. I'm not sure there obviously is, but Burberry shares are up quite nicely this morning.
Well, I'm struggling with that same segue. Right, Burberry shares surging. As the company says, it plans to cut up to 18% of its workforce. Fourth quarter sales fell 6%, slightly less than analysts had forecast. Lots of interesting lines coming through from Burberry around their operations in the UK in particular. Deborah Aitken, senior luxury goods analyst for Bloomberg Intelligence, joins us now. Deborah, good morning. So the stock's up 8%. The numbers, they reported a drop, but not as bad as expected, and they are taking action on the cost base. I suppose that's something that the investors are applauding this morning.
Yeah, I think it's about the forward view. There are no specific targets, but when we look at what's happened and the momentum through the second half of the year, we tried to break down the numbers. You know, they've guided down a couple of times this year, a slight beat in a couple of areas, but not much. So we saw top line down, 15% operating margin fall to 1%, adjusted operating margin from 14%. Big take back on things like their inventory, where there was too much in the marketplace. And under Josh Schulman, the new CEO since last July. He's really looking at this Burberry forward and focusing on the core, and that's the idea. And within that, between November when they announced their first update to now, they've found an extra 60 million per annum cost savings through 2027. So 100 million in total, and that includes, as you've mentioned, some of those job cuts.
Well, Deborah, walk us through some of those jobs cuts, because we're getting headlines crossing the terminal now from the Burberry CEO saying that those jobs cuts are targeting the office and the retail roles. We're seeing a market that is rewarding Burberry for what they put out this morning. And I'm curious how much of that is due to that organizational change. This is, I think, one of the latest series of organizational changes that Burberry has had.
Yeah. So there are 1,700 job cuts. I think some of the headlines say that's around 18% of the market, cutting out things like overtime, overnight, reducing volume, which is needed in this marketplace. And I kind of think that this is Burberry working a little bit ahead of the curve in some ways, given that it's in a strategy overhaul. It's focusing on core. It's been bringing down some price points in categories where it doesn't have the right to have those prices, according to the new CEO and the market in general, given demand has been so difficult for the last couple of years for them. And I think we'll see more of this overall come from other companies, given the biggest issue in the marketplace for luxury right now and the changes between tariffs day by day, week by week, country by country, is about consumer sentiment. So for Burberry, it's about getting the brand back on track and really kitchen sinking while it can. Yeah. And I think that the market is appreciating that and saying, OK, we start with a negative net profit. We start from a base and maybe we get back to sales growth within a 12 rather than an 18-month view.
I've heard of the Castleford Tigers, the rugby league team. I hadn't heard of Castleford, the factory. They're cutting the overnight shift from. Is this what we're going to see elsewhere?
I believe so.
So you talk about the being ahead of the curve. Presumably this is going to have to be, therefore, writ large across the entire luxury industry. Is this something that LVMH is going to have to do? Is this something that, dare I say, even Hermès might have to do? How far does this reach? How far does this strategy reset reach into the luxury sector, do you think?
If we think about Burberry in particular for a second and combine it with the likes of Gucci brands, Salvatore Ferragamo, what's been happening with Michael Kors and others, they've been brands over the last couple of years that just haven't resonated and they've had to make big changes. Yep. And Burberry is probably one of the first to really start to come out at the other end a little bit, though it's still a long road ahead and bumpy. Yeah. But if we look at Hermès, for example, Brunello Cucinelli and others, their volumes are restricted, so that's a different program. Okay. And within the LVMH group, it's about looking category by category. So the Moet Hennessy side, looking at cognacs being difficult in the marketplace, some of the watch volumes and others. So I think we'll be taking it brand by brand, company by company.
Deborah Aitken walking us through the luxury story this morning from Bloomberg Intelligence. We thank you so much. Coming up, we're going to shift our focus right back to the Middle East. Donald Trump meeting with the Syrian president right now. We're going to get more on that next. This is Bloomberg.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and And it's on all these lovely channels. Hope you're jotting this down.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
This is the opening trade. We're 30 minutes into today's session. I'm going to say we're not actively selling here. Euro stocks 50 are down about 0.1%, and your biggest weight this morning is coming from LVMH into the CAC 40. And even then, the French index is only down 0.4%. Caution seems to be the name of the game across of these indexes. But again, let's wait and see what happens on the geopolitical front, because, of course, Donald Trump has arrived at the GCC Leader Summit taking place in Riyadh. And at the moment, speaking to the Syrian president, let's go right there to Riyadh with our very own Horizons anchor, Jumana Bersetchi, joins us now from the Saudi capital. Jumana, as I said, Donald Trump in a historic meeting with the Syrian president. Walk us through what we can expect from that conversation.
Yeah, most definitely, Kriti. And if yesterday was about deal making, those flashy announcements of investments and MOUs, agreements signed between Saudi Arabia and U.S., today the focus is going to be on regional security. Also unprecedented to have an American president chair what is a GCC leader. We're expecting to see a family portrait photo taken with those GCC leaders, some of them being represented by the Crown Prince, as in the case of the UAE. But the other major headline that came out of Trump's speech yesterday was his announcement that they are looking to remove sanctions from Syria. It came as a bit of a surprise. He credited the Crown Prince for pushing them in that direction, and of course gives further legitimacy to this very nascent Syrian government that is being led by Ahmed al-Sharia. And Ahmed al-Sharia himself was invited to the GCC summit that's taking place right now. As we understand, the two are engaged in a bilateral meeting. So this is President Trump meeting with the new Syrian president, having a conversation now. Overnight, the foreign ministry put out a statement saying they welcome the removal of these sanctions, that Syria wants to use this as an opportunity to rebuild and focus on economic prosperity after a decade of war, civil war, sanctions that have crippled the economy and has led to a huge reconstruction need that is going on in Syria right now. So it is a big deal, and it's also noteworthy because Ahmed al-Sharia, the Syrian president, has only had one visit abroad outside the Middle East, and that was to France last week. He met with French President Macron, and so this just is another step in the direction of adding legitimacy to that government, and it's part and parcel of the Trump administration's bigger plans, which is ultimately what they want to do is to make sure that this becomes a region of stability, of economic prosperity, and to move away from one of wars and strife.
Jumana, what is the overlap now between US foreign policy and Saudi foreign policy?
Yeah, I think that's a very pertinent question to be asking, given that the U.S. came here and President Trump came here talking about these huge ambitions and deal making, and perhaps the media, we got a bit caught up with some of those headlines and thinking that there wouldn't be as many geopolitical breakthroughs. But I think from the Trump administration's perspective, yes, economic prosperity, economic opportunities are going to be front and center, but at the same time, in order for that to happen, you need to see stability in the region. From my conversations with GCC leaders, representatives over the last few months, they talk about de-escalation. They talk about bringing down the temperature in the region. And it's very welcome, I would say, from Saudi Arabia's perspective, that in his speech yesterday, President Trump talked about wanting to make a deal with Iran. And remember, Iran and Saudi Arabia only last year had their own form of a détente because up until then there had been an active animosity between the two sides. But the Crown Prince, in light of his vision and diversification efforts and the focus on the economy, wanted to sort of ease things on that front so that there could be a focus on opening up the country. And from Saudi Arabia's perspective, look, Crown Prince got a lavish amount of praise from President Trump yesterday. He really went out of his way to talk about what Saudi Arabia is doing. He firmly placed Saudi Arabia on the global map, both geopolitically and economically. You had many of these very senior U.S. business leaders fly in for that summit yesterday. The likes of Larry Fink saying in one of the panels, traditionally Saudi Arabia was perceived to be an exporter of capital, but now it's positioning itself as a destination for investment. So again, an evolution from an economic standpoint, which is what the Crown Prince is really trying to showcase to the world.
And we saw that on display from some of the US tech names on this tour with the president. Thank you very much, Bloomberg anchor Jemana Besetter, of course, in Riyadh for us. Let's lend a European dimension to the conversation around the Middle East. The French President Emmanuel Macron has urged the European Union to step up pressure on Israel over the humanitarian situation in Gaza. For more, let's go to Bloomberg's Caroline Conan, who's in Paris for us. Caroline, Macron accused Prime Minister Benjamin Netanyahu of Israel of shameful behavior in blocking aid to the Palestinians. Is this a toughening of the language? How much other support is he getting from the rest of Europe?
Yes, in fact, Macron spoke on live television last night for about 3 hours. We were expecting him mostly on domestic issues, but he made headlines on the international issue, especially what he was saying about the Israeli Prime Minister Benjamin Netanyahu that could be interpreted as a change of tone, perhaps toughening his stance on the Israeli Prime Minister. We know that Emmanuel Macron has been pushing for the creation of a Palestinian state, of a double state solution with Israel and Palestine. We know that Emmanuel Macron actually recently, at the beginning of April, went to the border between Egypt and Gaza and said what he saw there was very brutal. So last night, again, he repeated what Israel is doing in Gaza is unacceptable, blocking this humanitarian aid and access to water for the Gaza people. He actually also is trying to push for some kind of normalization between Saudi and Israel, which is kind of interesting given what's happening at the moment with Donald Trump's visit to Saudi. Donald Trump, who actually said yesterday it was kind of his dream to see Saudi join the Abraham Accords with Israel. So clearly Emmanuel Macron is trying to get some kind of shift to European tone towards Benjamin Netanyahu. This comes also after the Netherlands already said that perhaps we need some kind of collective reassessment of the European policy towards Israel.
Caroline, walk us through some of the other highlights outside of some of the geopolitics that Macron was talking about.
So what he was expected to announce was some kind of referendum. We know that Emmanuel Macron said in his New Year's Eve address that the French will vote on something at some point this year, and he repeatedly denied that he's going to call again new snap parliamentary elections. However, he is willing to call the French to vote on a referendum on a number of issues, perhaps assisted suicide, perhaps access of children transition to screens, of perhaps even reforming the voting system to make a bit of proportional system rather than the two-round system for Parliament. What he excluded last night was a referendum on the retirement reform. He doesn't want to move the retirement age that he spent months to raise to 64 years old a couple of years ago amid months of protest. And also he doesn't want a referendum on immigration, which is something that the far right has been demanding. So we could see a multiple question referendum in the fall, and in fact a majority of the French is in favor of that. We could also possibly see a referendum on debt and deficits, which is what the Prime Minister François Bayrou has been suggesting. The risk, of course, is to make this a plebiscite for or against Emmanuel Macron.
Yeah, that's a significant risk, and he's taken big risks in the past, and they haven't always necessarily worked out for the president. Caroline, thank you very much indeed. Caroline Cullen joining us from Paris. Let's turn our attention to what's happening in the UK, where the Defence Secretary says the UK and the EU are in the toughest stages of talks, aiming to secure a common security and defence pact. John Healey spoke to Bloomberg's Lizzie Burden about his goal to secure access to European spending programmes for British firms.
Well, we're in the sort of hardest yards of the negotiations. We're a government that, even before the election, said that the security challenges we face in Europe require the UK and the EU to work closer together. We've been willing and ready to do that, and we've said from the outset that we're ready to strike an agreement if the EU will do so too.
UK Defence Secretary John Healey speaking to Lizzie Burden. A lot of moving parts around the UK at the moment. You've got this defence story which is developing. Are we going to see some sort of a deal done around that? It looks like obviously some progress has been made, more potentially to come. But we're also looking at this immigration story as well around the youth mobility scheme, which is really kind of beginning to heat up and probably will heat up more over the next few days. It's interesting to juxtapose it with the push that Starmer has made recently on curbing immigration. This potentially speaks to the other side of the coin on that one.
And how much can you sort of divide it by generation and keep the views separate will be a tough political challenge. Back to the defence theme we were hearing there from the UK Defence Secretary. Well, NATO is sketching out plans to meet Trump's call for 5% spending on defence, which goes a little bit further than what the UK has already set out. This is by 2032, according to some of our reporting, as we build our way towards NATO meetings taking place this week as well.
Yeah, it's fascinating, especially going into the potential talks between Ukraine and Russia into the next 2 days, where he specifically, John Healey, I believe in our interview with Lizzie Burden, said that Russia is not taking Ukraine peace negotiations seriously. So, and also keeping one eye on that.
Yeah, lots of geopolitics to focus on, lots of trade conversations to, of course, keep under review. With that in mind, coming up, we'll be speaking to the Renault brand CEO, Fabrice Cambolive, about how the company has been navigating Trump's tariff turmoil. Less exposure to the US than some brands, so perhaps that's an advantage, but it has the potential to disrupt entire supply chains. So we'll get into that next. This is Bloomberg.
Had a number of games overseas in recent years, and in fact, you opened the season going to the opening game in Brazil. So do you expect to do more overseas games, and is that a part of your strategy?
It is.
We had 5 last year. We expect to have 8 this year, which will be the highest we've ever had. Our hope would be at some stage to get to 16 games in the next few years. We think we could do that. I think it's an indication of the popularity of our game. Every time we take our game to a new market, Brazil's a great example of it, the fans go crazy for it. They sold out the tickets in less than 90 minutes. People had a wonderful time. It was the talk of the town. And I think it will be the basis and the sort of the match that lights the excitement and the popularity of the game in that market, as well as what we're doing around the world. So we're very excited by it. It's just one element of that strategy. You need to have television. You need to have activity and participation in the sport, and flag football is a big part of that. So all of those factors, I think, are going to be what we think will be a very successful formula to be a global sport.
Do you ever envision having a team that's based overseas in Mexico City or in London?
Listen, we've talked an awful lot about it, and I think there are markets that could, without question, support an NFL franchise.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Welcome back to the opening trade. We're 44 minutes into our European session, and this is the picture we have for European stocks right now. The FTSE is entirely flat. A little bit of underperformance on the CAC and the DAX right now. Some corporate earnings cutting through. The bigger picture, macro drivers, though, a little unclear right now. Where does the next catalyst come from? US futures look almost entirely flat. Slight upside then, Guy, when it comes to NASDAQ futures. We had a good day for tech stocks yesterday, and perhaps we see a little bit of that, but really not much in evidence.
No, a little bit of a cautious set. Monday was the amazing session. Let's talk about what's happening in the car sector. Nissan shares trading a little lower today after it posted full-year net losses of $4.5 billion, its biggest annual loss since 1999. The car maker says it will close 7 factories and slash 20,000 jobs as the CEO looks to accelerate the restructuring plans. Analysts not entirely convinced. Citigroup says those plans look inadequate and don't seem to include a tariff impact. We are going to be, I think, talking to the Nissan CEO a little bit later on, so stay tuned for that interview, not on this show, but right here on Bloomberg. With that in mind, let's bring in the Renault CEO, the Renault brand CEO, Fabrice Cambelive. Nice to see you. Good
nice to meet you. Thank you.
Nice to meet you too. The car industry is caught up in so many different things right now. You've got the tariff story, you've got a technology story, you've got a drivetrain story. There's so many things that are changing within the industry. And I'm wondering how you think the industry is adapting to that process and how consumers are reacting to that process. What do you think consumers want right now? What are they looking for in a car? Because it seems like choosing a car at the moment is one of the most complicated decisions you'll ever make. It used to be really straightforward. Like, was it a diesel? Was it a petrol? How big do you want the engine to be? How fast do you want it to go? How comfortable do you want it to be? But that conversation is now much more complicated.
I mean, the consumers are like we are. It means they need visibility.
Yep.
Visibility on the technology, visibility on the regulation, visibility on the price.
Yep.
Visibility on the residual value of the car after 4 or 5 years.
Yeah.
That's why you have and we have to make the right technological choices. If you come back 4 years ago, at the beginning of the electrification of the market in Europe, you could have chosen different ways. Should I go to hybrid? Should I go to diesel? Should I go to pure BEV electric car? It means we had to make bold choices, but also a kind of two-leg strategy. We decided on one hand for the people who want autonomy to propose on all our IC cars hybrid technology, which is allow you to have a low consumption but a very high autonomy. And for the pioneer, we decided to renew our BEV lineup on pure dedicated BEV platform. That's the way we decided to give and to open the choice to our customers.
We were joking, and we were joking earlier on in the show, and Chris going to roll her eyes at this point, talking about the kind of the Renault 4. I can't remember the Renault 4.
I was getting nostalgic about vividly. The Renault 5.
What a car. And you said that, and you said, this is why we do this. We bring back these vehicles because there's a certain familiarity. Does that familiarity make it easier for consumers to make difficult choices when they think about what has happened? They remember these vehicles. This is just the latest iteration of this vehicle. Does that make is it sort of camouflage for what is happening, but consumers are more relaxed, therefore, with the decision?
I mean, I think if we would have decided to electrify an IC car, a normal existing IC car, it would have been a boring job.
Yeah.
When you come back to the 60s, when you come back to the 80s, and you reinterpret a car, but focus on the modernity, focus on new technology, you can, at the same time, have a blend of emotion and technology. And I think that's what we decided to do with R5 first, and look at the results. The car is a very emotional car.
Yep.
When you drive the car, you attract the sympathy of the owner, which is quite unique. And that's why we decided not only to do that with R5, but to do that with R4, which is very complementary to R5 in terms of practicality, versatility, trunk roominess.
How are they trying to put the gear lever in? The amazing gear lever in the Renault 4.
Yeah, we tried to do that, but unfortunately, due to safety reasons, it was very difficult to put that.
Okay, and in our conversation in the break, Fabrice, you were talking about the Madeleine de Proust, so suggesting that this triggers all kinds of nostalgic memories for consumers who remember these cars of old. Let me bring things right up to date, though, right now. President Trump in the White House. Now, obviously, the Renault brand sells little into the United States.
We are not present as a brand in the United States.
But the secondary impact on the sector in terms of supply chain issues, is that something that you are having to deal with? Is it having any impact on what you're doing?
Now, of course, we are watching that closely. But, when you go through all what happened in the last 20 years, tariffs are just part of the story, part of the equation. On top of the tariff, you have rates exchange variation, you have logistic supply chain problems, you have regulations changes. It means when you want really to be present in a country, of course you can choose the easiest way is to export car from one country to another. But I think the best way is to localize and to produce in the country.
Yes.
We are not present in the US, but we are present in many, many different regions. In Latam, in Brazil, in Korea, in India, in Morocco, in Turkey. And in each country, we try to be very balanced, localization and the capacity to sell on the spot and to export the cars.
Yes.
I think in this context, which is quite uncertain, the risk management is more important than everything else. And for that, you need to be very balanced.
Yeah. When you talk about that risk management story, and I appreciate that you're not in the U.S. as a brand, talk to us about, and Anna mentioned it from a trade perspective, I'm curious about from a kind of EV perspective as well. A good chunk of the world, even in the UK here, are pulling away from that kind of EV dominance that I think was such a big factor over the last couple of years. What is Renault doing there, especially when we're seeing European car sales, for example, in the EV space rise, but the likes of Tesla, which I would say is the kind of main name brand of an EV, drop? How does that factor into where Renault stands?
I think when the level of EV in the European market is at 17%. It means it's quite high already. I think for me there is no comeback, but there are still a lot of room for us to grow. And by the way, in the first quarter, thanks to the arrival of R5, we grow by 80%. For me, what is important is to be able to tackle each segment of the market. In UK, we began, for instance, on the C segment in a very, very competitive segment, which is a main segment in UK. But what is interesting now is that with R5 and tomorrow R4 or even Twingo, we are now targeting a new type of customer, which is a retail, on a small compact car for the cities or for the campaign. And for me, this is very interesting because this shift will enable us to catch a growth which is still, and the margin is still huge because you tackle 30% of the market. It means, to come back to your question, the point is not to grab sales from another brand because we are all solidaire in this growth in terms of EV, which is which is a very bumpy road.
Yeah.
And somewhere, the other electric vans are road companions. What is important is really to shift the diesel customer to EV. And for that, we need to tackle each segment, and the B segment will be one of the key segments in Europe in the next months.
And Fabrice, we were just listening to Elon Musk just earlier this week, in fact, on tour with President Trump in the Middle East, talking about bringing robo-taxis to that region. And he's been trying, of course, in parts of the United States already. That's one area where we're seeing a lot of technology innovation. We hear stories from the Shanghai Motor Show about the amount of innovation in the cabin for drivers from the who is setting the pace, and I know the short answer will be Renault, but where are you looking for the pace to be set in terms of the technology? Where does that threat come from?
I think clearly now we are learning a lot from China. You're right, and I was in Shanghai 1 month ago, and the level of autonomy of the cars is quite impressive. But I think what we have to be smart and to use this technology to make our cars even safer in Europe. I don't think there is a lot of time before to have a pure autonomous car, but a lot of innovation can be put in our cars to increase the safety of our cars, and this is what we are aiming for Europe. But source of inspiration is clearly China. You're right.
But if you're and we'll put safety to the side for a moment, but if you're trying to, and you made this comment, you're trying to switch a diesel customer to an EV customer. Isn't the core of that making it cheaper? How do you make an EV cheaper right now?
I think the first way to make cars cheaper is to reduce the development time. Look at the car before. We needed 5-6 years to develop, conceive, engineer, produce a car. With R5, it was 3.5 years. With R4, 3 years, and with Twingo, which will come in UK, 2 years or less than 2 years. It means when you reduce the time of development, you reduce the entry ticket of the car, you reduce the price. Okay. The second point for me is after that to build EV car on dedicated platform is enabling you to get the essential of compact sizes. The interior roominess of a Scenic, which is a quite compact car of the C segment, is like a D segment car. It means you give more for less. This is also something very interesting. And the last point is when you speak about EV, you can upgrade the car during the life cycle. I think EV versus IC cars have this big advantage to be able to last more. And this is very important because you can upgrade the car, what you couldn't do in the past with an IC car.
All right. Fabrice Cambolive, Renault brand CEO, joining us around the table, walking us through what Renault's plans look like, how they're thinking about the EV story, of course, how they're thinking about the tariff story as well. Let's turn our attention right back to Riyadh, where Donald Trump is still, I believe, concluding his meeting with the Syrian president, according to our White House pool there. It looks like they're setting up for a photo opportunity with MBS in Riyadh, a historic moment, concluding his first stop on his Middle East tour, marking his first foreign trip in the Middle East.
Yeah, we certainly have confirmation from the White House pool that Trump's meeting with the Syrian president has ended, so perhaps making his way to this photo opportunity. We also had reports earlier on, Guy, that Erdogan, Trump, Mohammed bin Salman and the Syrian leader were holding an online meeting, so a lot of dialogue behind the scenes.
What happens tomorrow is the next big kind of piece in the puzzle. Where does Donald Trump go next, I think, is another interesting piece in the puzzle as well. Thursday, is he going to find himself in Turkey? Anyway, we will see what that story does and how it develops going forward. We will leave you these pictures from Riyadh. This is Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday, only on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
The U.S. president and the Saudi crown prince, of course, tout pledges for $1 trillion worth of deals, but the details are scant so far. U.S. tech takes center stage with NVIDIA, Amazon, and AMD among those announcing more projects in the Middle East. Plus, NATO puts together plans to meet U.S. demands for members to spend 5% of their GDP on defense. So there is a lot going on. We have our eyes firmly on the Middle East. And, of course, we watch what President Trump does or signs next. This is a picture overall for the markets. Now, it's very clear that stocks are fluctuating. Traders are waiting a fresh catalyst maybe for the rally that erased the S&P 500's loss in 2025. Again, we're in the middle of this U.S.-China trade truce, and that's been reigniting some demand for technology shares. Now, a couple of the other things we're watching out for, it's clear also that President Trump has put U.S. technology initiatives at the center of his visit to the Middle East. Speaking to the Middle East, these are live pictures of the Crown Prince of Saudi Arabia with, of course, the President of the United States. We have heard from some companies in, of course, Riyadh, including NVIDIA, but also AMD, that were up after announcing they would supply semiconductors to a Saudi Arabian artificial intelligence firm. Now, markets are digesting this frenzy of diplomacy as President Donald Trump does deals in the desert, and traders hold out for signs of more progress in U.S.-China trade talks. Let's start with the latest on Trump's Middle East tour. The U.S. president and Saudi Arabia's crown prince touting pledges for $1 trillion worth of deals. Now, the total amount is unclear, but the White House later saying that investments are worth $600 billion. Trump also touched on the region's geopolitics, urging Iran to make a nuclear deal and vowing to lift sanctions on Syria.
Apple is investing $500 billion. NVIDIA is investing. TSMC is investing $200 billion. And with this trip, we're adding over $1 trillion more in terms of investment. I have never believed in having permanent enemies. I am different than a lot of people think. I don't like permanent enemies. If I can make a deal with Iran, I'll be very happy if we're going to make your region and the world a safer place. But if Iran's leadership rejects this olive branch and continues to attack their neighbors, then we will have no choice but to inflict massive maximum pressure. I will be ordering the cessation of sanctions against Syria in order to give them a chance at greatness.
We understand that President Trump may also be meeting the new Syria leader after lifting some of those sanctions. Let's go straight to our Bloomberg anchor, Jumana Barseche, who's joining us from the Saudi capital, Riyadh. Jumana, good morning. So President Trump is meeting with the Syrian president. This feels like a very big deal.
Absolutely. So, Francine, if yesterday was about deal-making, those big headline investments and agreements, MOUs being announced, today is about regional security. You're looking at images of a GCC Leaders Summit that is taking place right now. The biggest names, the biggest heads of state from the region, all congregating here in Riyadh. Abu Dhabi, represented by the Crown Prince, but we have the Qatari PM, the Emir of Kuwait, all of them attending this meeting. And then one surprise visitor, and that is the Syrian President, Ahmed al-Shari'a. As we understand, President Trump just sat down with him for a more than 30-minute conversation, a bilateral conversation between the two. This coming on the heels of that major announcement that President Trump made during his speech yesterday, that the U.S. are looking to lift sanctions on the Syrian regime and Syrian government, I should say. This after a decade, more than a decade of civil war, an economy that has been ravaged both by war, but also the weight of those economic sanctions, and is part and parcel of an effort to rehabilitate the Syrian government and bring them back into the international community. For his part, the Syrian President Ahmed al-Shari'a has only actually made one visit outside of the Middle East, and that was to France last week. He met with the French President Emmanuel Macron. So there were expectations building that there would be some sort of announcement of some sort in this coming week vis-a-vis those sanctions. But yesterday, that was one of the big headline grabbers from President Trump's speech. And he also credited the Crown Prince MBS for getting them across the line, in addition to the Turkish president as well. So a major milestone, and also just tells you about the Trump administration's priorities in the Middle East. And that is one, to help some of those governments that in the past were allied to Iran to break away from Iran's grip and hopefully usher in an era of stability and economic prosperity.
Jumana, also, I mean, deals were announced. We're quite thin on details, but talk us through them.
Yeah, so the major headline is that $600 billion pledge from Saudi Arabia into the U.S. Later, during the speech, Crown Prince Mohammed bin Salman did say that they're looking to beef up that number to get to $1 trillion. We don't know exactly how they're going to get to that figure, especially given some people have pointed out $1 trillion is basically the size of the Saudi Arabian economy. But what we do know is the deals that were inked, the MOUs that were signed yesterday at that business forum, amounted to about $300 billion. And here we're talking about one major defense deal, $142 billion worth. The White House saying that is the largest defense deal in history, with Saudi Arabia pledging to buy arms and weaponry from the U.S. Another deal in AI space, so you were talking about that earlier. Big one for some of those U.S. chip makers, NVIDIA and AMD, which bounced on the back of that news. They're going to be supplying AI data centers with chips needed to power those data centers. So that was a big breakthrough as well. We talk about further energy cooperation, Aramco looking to invest more than $4 billion in a Texas refinery. We also had an announcement from a PIF-owned aviation leasing company. They're going to spend more than $4 billion on Boeing 737 MAX jets. So lots of deals being inked. The headline figure, though, $600 billion. They're working towards the $1 trillion figure.
Jumana, thanks so much. Jumana Barseche there in Riyadh. And then we're also listening, of course, to the Crown Prince of Saudi Arabia in that, well, it's not a press conference, but he's certainly speaking to dignitaries and chief executives. Now, let's also bring in Aaron Captain. He's Global Head of Economics and Strategy Research at UBS. Aaron, thank you for joining us. Look, without focusing too much on the Middle East, I mean, it feels like a new dawn. It feels like Donald Trump wants to do deals, or certainly he puts tariffs, but then, you know, there's always a negotiating tactic. Is this different, Donald Trump, to what we saw 3 weeks ago? And does that have an impact of your economic forecasts?
Not really. One of our political consultants called this a vacation from contention, right? They think he's in his comfort zone in the Middle East, making deals and basically exchanging, I think, defense commitments for investments. So no, I think the way, in the tradable universe, we obviously look through an oil lens. So, is there anything that's being discussed that has a bearing on that? Now, I think Iran certainly does. We're already now, though, at oil price levels where really any new production in the U.S. is not profitable. So it's sort of interesting where this is going. There's been this real push both on the part of Saudi Arabia to basically increase output and get oil prices down. There's been a push by Trump to also get oil prices down. It's working, right? So I think we're going to see it in tomorrow's PPI data. I think we've already seen a little bit in yesterday's CPI data, and potentially more to come. But we're now at these levels where you're going to start to have a production impact. So how that impacts, I think, the U.S. economy remains to be seen.
But Aaron, I mean, what did you learn about his deal making with China, for example? So this is, I think, without a doubt, in terms of the economy, the biggest game changer. Let's see what happens in 90 days. But if he's giving China a potentially better deal than the UK, after slamming them for so many years, how do you change actually your forecast, and what does it mean for other potential deals? Yeah,
I mean, I don't think he's given China a better deal than the UK, right? I mean, China is now at an all-in tariff of something like 43.5%. The UK is at about 9%, right? So it's not quite comparable. But yeah, it was very surprising, right? So, Bessent has basically sort of said that, the landing zone after 90 days is somewhere between 10 and 34, so that is meaningful. Now, very unclear how the border tariffs feed into that, whether they're stacked on top of, they can be consolidated. But yeah, that's a meaningfully better outlook. So if you just take at face value where we are today, then the weighted average U.S. import tariff has gone from about 24, 25 to 15, right? Yeah. But it was 2.5 at the start of the year, right? So it's still a sort of meaningful slowing. We have the, the pharma tariff still coming. We have the semi-tariffs coming. The comment period for minerals and trucking ends, I believe, on Friday. So, and we're still in this 90-day pause where things should actually go up, right? So I think the concerning thing for us,
don't cry victory.
It's too early to declare victory, and I think what's worrying about the UK deal is that if you do not touch the 10%, which is basically what everyone is subject to, then that's a problem, because then really are we sort of at peak relief right now, where now the tariffs can sort of only drift back up.
Yeah, and I didn't mean to say that actually the UK had a worse deal, but from where they started, China was better at negotiating.
Well, you're right. You could come down from a much higher level. So, look, so economically, this means you go in the U.S. from a 2.5% of GDP import tax to a 1.5% of GDP import tax, all in. Yeah. That's going to be worth, we think on the U.S. growth numbers about 40 basis points.
I'm going to cut you off because the president's speaking. Let's listen in.
Oman, Kuwait, Bahrain, all friends. As I said in my address last night, the Gulf nations are at the forefront of creating a stable, peaceful, and prosperous Middle East. And I have to say that I've seen such progress. It's really incredible. I've also seen great unity and friendships. I've spent a little time with you just before this, and I've seen tremendous unity, tremendous friendship, and the whole world is watching the Middle East, and many are watching with envy. You have something very special going on. Incredible opportunities are within reach for this region. If we can simply stop the aggression from a small group of pretty bad actors. The Biden administration created havoc and bedlam by basically being incompetent, but by empowering Iran and its proxies, sending them billions and billions of dollars, senselessly. I couldn't believe it to watch. One of the reasons I said, let's do this again. But what they did was so bad, while turning his back on the Gulf allies. Those days are over. Everybody at this table knows where my loyalties lie, always have. They'll never waver, never. And we'll stand with our friends and partners, and we'll confront the aggression that threatens us all. I want to make a deal with Iran. I want to do something if it's possible. But for that to happen, it must stop sponsoring terror, halt its bloody proxy wars, and permanently and verifiably cease its pursuit of nuclear weapons. They cannot have a nuclear weapon. I don't imagine there's anybody at this table or anybody in this room that would say they can. I'm strongly urging all nations to join us in fully and totally enforcing the sanctions that I just placed on Iran, and we also place secondary sanctions, which are in certain ways even more devastating. Iran, as you know, had no money when I left office. They were broke. They had no money for Hamas. They had no money for Hezbollah. There was no attack. There was no thought of attack. There would have been no attack if I were president. But bad things happened in that election. And I said, let's do it again. And by doing it again, it became much more historic. It's a much more historic election, much more powerful election. And we have a mandate. We won every swing state. We won by millions of votes. We won 2,750 districts. We call them districts out of a total. If you look at the number, it was 2,750 to 505. The whole map was red meaning Republican. So I will say recently we launched strikes on more than 1,100 Houthi targets in Yemen, as you know. And last week they agreed to stop. They don't want to be targeting our commercial ships anymore. And they said, that's enough, that's enough. We did about 52 days, 52 nights. It didn't end. We just put in a budget of $1 trillion. It's our biggest budget, military budget we have ever put in. And the United States is very, very strong right now. It's amazing. In a short period of time, we've been there 100 days. And in a short period of time, we've done what a lot of people don't do in 4 years. We're a hot country, just like you're a hot area. And we're going to keep it that way. In Gaza, my administration shares the hope of so many in this region for future of safety and dignity of the Palestinian people. But that cannot happen as long as Gaza's leaders take delight in raping, torturing, and murdering innocent people. Can't have it. I greatly appreciate the constructive role that the leaders in this room have played in trying to bring the terrible conflict to an end, including by helping secure the release of American hostage Edan Alexander. It was a big day yesterday, a very important day. I was told just before I left that they were going to be releasing Edan. We thought Edan was dead 3 weeks ago. They said Edan was no longer living. And it was a very, very good thing. Ultimately, all hostages of all nationalities must be released as a stepping stone to peace, and I think it's going to be happening. A lot of things are happening. A lot of very positive things are happening on every front. With the support of leaders in this room, and they're great leaders, you are, we are currently exploring normalizing relations with Syria's new government, as you know, beginning with my meeting with President Ahmed al-Shara and Secretary Rubio's meeting with the Syrian foreign minister in Turkey after discussing the situation with Crown Prince Mohammed and President Erdogan of Turkey. I am also ordering the cessation of sanctions against Syria to give them a fresh start. It gives them a chance for greatness. The sanctions were really crippling, very powerful. And I spoke to Mohammed, and I spoke to our friend from Turkey, who we just spoke to also by phone now, but felt very strongly that this would give them a chance. It's not going to be easy anyway, so it gives them a good, strong chance. And it was my honor to do so. So we will be dropping all of the sanctions on Syria, which I think really is going to be a good thing. And we made a speech last night, and that was the thing that got the biggest applause from the room. We had a very crowded room with thousands of people, and the statement that got the biggest applause was dropping the sanctions on Syria. Likewise, in Lebanon, there's a new chance for a future free from the grip of Hezbollah terrorists if the new president and prime minister can rebuild an effective Lebanese state. We just appointed a very good ambassador, a friend of mine who's Lebanese, and I didn't even know that. And I said, why do you want to be the ambassador to Lebanon? That could be dangerous. He said, I don't care. I grew up there. I love the country, and I don't care if it's dangerous or not dangerous. I want to do that. And he's a very capable man, very successful man from the United States, and he's going to be your ambassador. He's going to do a great job. But this is a once-in-a-generation opportunity to forge a Lebanon that is prosperous and at peace with its neighbors. And I think things can really happen there. They've had a tough go of it for a long time. At the end of my first term, all of the momentum in this region was toward peace. I especially want to thank and congratulate the United Arab Emirates and Bahrain for their vision and courage in signing the historic Abraham Accords. It was something that's a very big thing. I believe we would have had it filled out had the election been called fairly, which it wasn't. It was a rigged election. I hope that in the near future we can continue that progress. We have a mandate from the American people, the likes of which people haven't seen for 129 years. They say it was the most consequential election in America in 129 years. So that sounds like a long time, so we'll take that. But in the future, we'll continue that progress by adding more countries to the Abraham Accords. We have 4, and I think they're going to be filling up very rapidly. Biden didn't do anything because he never did anything about anything. He had no capability, he had no ability, and it was a shame what he's done to so many countries, including our own. We had an interesting fact. About a year ago, there was a story that we're having a hard time getting enlistments into the military, and it was at the lowest level almost ever. People didn't want to go into our military. And it just came out last week, you probably saw that we have now the strongest enlistment in the history of our country. They say 38 years. One said 37, one said 32, and one said ever. So we just had the strongest enlistment in the history of the United States of America. So think of it. In 1 year, we went from they can't get people to enlist to we have the strongest enlistment. And that includes the police departments, too. We're having a hard time getting people to be police, the great law enforcement arm that we're known for, and now we're setting records. It's hard to get a job. I mean, frankly, the lines of people wanting to be police officers and go into the military, and it's a matter of spirit. We have great spirit in the country right now. We've done a lot in 100 days, I'll tell you that. It's all started on November 5th with the election. But a stable and peaceful Middle East will be a successful and prosperous Middle East, and that's what you've done, and that's what you're doing. And, you know, it's amazing because when I was here last, it was fine, it was doing good. And then I see the things that you're doing here and in your countries. It's just incredible what you're doing. Is the whole world is talking about it. The whole world is watching us. Look at all the news over there, the fake news. Look at them. The whole world is talking about what you're doing, and you're the envy of the world. Together, we're in this room, and we're going to forge a Middle East that will be a thriving commercial, diplomatic, and cultural crossroads at the geographic center of the world. That's what it is. It's the center of the world. I look forward to working with you, and I want to thank Mohammed. I want to thank you, Crown Prince. We have a special relationship. We have long had a special relationship, but it was an honor to spend a couple of days with you, and I'll see you again soon, and I'll see you a lot. Thank you all very much. Thank you.
شكرا فخامة الرئيس على كلمتكم والآن أدعو جلالة الملك حمد بن عيسى الخليفة ملك المملكة.
So that was President Trump. We're now hearing, of course, from the Crown Prince. First of all, they were touting this $1 trillion pledge, and some of the details remain elusive. And then, of course, President Trump, in a speech that really touched many, many things, including the elections in the U.S. a couple of times, said that he was exploring normalizing relations with the Syrian government. There was a very friendly chat, especially at the end, between the Crown Prince and President Trump, saying that the Middle East certainly seems like it's the center of the world right now. Now, to talk a little bit more about the markets, to talk a little bit more about the implications, maybe of some of these new friendly relationships, let's get back to Aaron Captain. He's Global Head of Economics and Strategy Research at UBS. Aaron, thank you so much for staying with us. We were listening to the speech together. I know some of the implications, of course, could have with oil, because Donald Trump has said he favors this $40 to $50 oil. But it seems that President Trump is focusing a lot on foreign relations at the moment. I mean, back home, it's all about inflation. So really, traders are experts in foreign policy whilst having to figure out what the Fed does.
And it's partly about inflation because everyone's sort of waiting to see when do these tariffs show up, what part of the data is it going to affect, how disruptive is it? And so you're going to see it, one of the first places you're going to see it is inflation. Now, I think yesterday's print, just to remind people, like that was an April print, which is really only going to capture what happened in February. There's about a 2-month lag, right? So back in February, we had really just the 10% border tariff on China. So we expected to see something. Now, on the good side, it was sort of an elevated print, but actually, frankly, difficult to disentangle from other non-tariff related elevated sort of goods price prints. So Not a whole lot of evidence yet in that print. Now, as we get to the next print, so that'll be a May print released in June, we're going to then have the March data. Again, that's before sort of the real tariff escalation. So you really have to sort of wait until you get the June release in July, where you start to see, I think, very significant sort of price impacts. And you can see that, for instance, also in the duties that have been collected, which really were sort of concentrated in April and not in March or February.
Aaron, I mean, a couple of questions. So I was actually in Iceland last Friday, and we spoke to John Williams. We spoke also to Governor Adriana Kugler. I mean, they have this dual mandate. There does seem to be a feeling that actually the Fed will focus more on inflation, right? Because that's what they really worried about. And so trade negotiations, as you say, go up and down. How many Fed cuts are you expecting this year?
Well, so we have 4, and it's actually counter to what their own models are saying. So I think you're right that if so they have about 7 different policy rules. If you put in the tariff impacts on inflation and on growth, you would get more inflation than you would get unemployment, right? And so in their models, what that would then imply is that the Fed funds rate needs to go up. Now, up until, I think, Powell's last press conference, I thought it was pretty clear that they wanted to ignore those models, right? So I think and it's sort of dealing with the sicker patient. So even if you have, an increase in inflation, if that is a one-off level shift and it goes back down, but unemployment starts to sort of drift higher, that's much more difficult to stop. So I think they want to ultimately react to a potential rise in unemployment, but they have this problem that the inflation impact is going to show up first. They're not back at target. It is still, even with this de-escalation, a very large inflation impact. We think you could be looking at 3.5% core PCE by the end of the year. And so I think they're going to have to wait. So we think, by the time you get to September, they'll be able to start delivering about 100 basis points in cuts. And at that point, we're going to see some weakening in payrolls.
Aaron, thank you so much. Let's also get to the Middle East, where our chief emerging markets economist, Ziad Daoud, is there. He works for Bloomberg Economics. Ziad, we were listening to the speech of Donald Trump together. Now it's the turn of the Crown Prince to speak. There's a lot of deals being touted, but will they really materialize?
Well, there are very large numbers that are being touted, as you mentioned, Francine. We're talking about $600 billion to $1 trillion worth of deals. Are they likely to materialize? I don't think so. The first reason is, if you look at what Saudi domestic funding needs, basically we estimate that they need an oil price of around $100 per barrel to meet their domestic spending needs. And that doesn't leave them with much to spend abroad. If you look at the market price, it's lower than that. It's around $60 to $65 per barrel, which is lower than the price that they need to fund their domestic spending. And that leaves them with a budget deficit, which we estimate to be around $70 billion this year. Now, here is the most important fact about the Saudi economy today. We often think of Saudi Arabia as a source of energy and capital to the rest of the world. It is still an important source of energy to the world, but it's no longer a provider of capital and funds to the global economy. Saudi became a net borrower from the world rather than net lender last year because it ran a current account deficit. It ran that current account deficit when oil prices were $80 per barrel. That is likely to continue when oil is at $60 or $65 per barrel. So are these deals likely to materialize? Some of them may be, but the large numbers that we're talking about, they're probably unlikely to come through.
Okay, thank you so much. Of course, what this also means is maybe there's trade being renegotiated depending on allies. Ziad Daoud there from Bloomberg Economics. Thank you, Aaron Captain, also of UBS Investment Bank. Now, coming up, the dollar weakens after Monday's gains. We'll discuss the outlook for currencies with the Goldman Sachs Global Head of Global FX. Now, the focus, of course, remains on the Middle East. The Trump administration, again, clearing a path for Saudi Arabia and the United Arab Emirates to pursue their artificial intelligence ambition. This was some of the big news that we had over the last 24 hours. U.S. tech companies like NVIDIA and AMD possibly planning to spend billions of dollars in the regions. This is Bloomberg.
you've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together. And that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
Or spoken, sorry.
My voice and my conversation, my poetry, you know.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. President Donald Trump says the U.S. is exploring normalizing relations with Syria's new government after the toppling of President Bashar al-Assad. U.S. tech takes center stage, though, with NVIDIA, Amazon, and AMD among those announcing more projects in the Middle East. Plus, NATO puts together plans to meet U.S. demands for members to spend 5% of their GDP on defense. So the dollar has weakened against the euro, yen, and pound after a bounce over the past few days. Now, for more, let's bring in Kamaksha Trivedi, head of global foreign exchange, interest rates, and emerging market strategy at Goldman Sachs. Kamaksha, thank you so much for joining us. I mean, there's so much going on, right? It's trade, it's U.S.-China, it's now everything in the Middle East. What happens to dollar from now?
I think the dollar is going to continue to weaken from here. I think the leadership might change a little bit. It's already been changing. If you look at the past 6 weeks, the first 3 weeks were very much dollar weakening against the safe havens, the yen, the Swiss franc, the euro, as we sort of priced up recession risks. Now, as we've seen some of the relief from the tariff side, as recession risks have come down, it's been much more the riskier parts of G10, the Aussies, the sterlings that have taken the lead, and emerging market currencies, of course, Brazilian real sort of been big lead. But I think the big change is going to be what happens in Asia. I think we've made a big shift to our views. We think the CNY is going to appreciate versus the dollar going forward. And that's an important anchor for global foreign exchange markets, but particularly Asian foreign exchange markets. So I think you are going to see dollar weakening against that complex as well.
Okay, I have viewer questions. I love viewer questions. So you see, they watch you, they see you, and they want to ask you a couple of things, which I'll get to. I have 1 or 2 questions on Germany and the 10-year there. But actually, when you look at the drivers for dollar, is the market reacting a little bit too quickly? When you see, trade and tariffs, fundamentally nothing's changed yet, and things could move quite fast. So how difficult is it to just get a feeling of price?
It's a fair question. I mean, I think there have been a lot of policy shifts. They're happening very quickly. I think the market is racing back and forth to price it. So certainly, a few days ago, it felt, we had, for example, for the euro dollar, a kind of, 3-month forecast of 112, 6-month forecast of 115, things that run quite far ahead of that. Now it seems like we've pulled back a little bit. I think that's fair. Nothing ever moves in a straight line. I think realized FX wall is high. I think it's likely to stay high for some time. But I think the broader trend has not really shifted, in my view. I think that U.S. exceptionalism is eroding. It's eroding gradually. I think these moves have longer to run, but of course you're going to see some back and forth over time.
Okay, so what do you do with treasuries? And again, there are a couple of questions. I mean, there was a treasury auction that didn't go so great, and the other one went really well. We don't know 100% know who is buying into that, but where do you see treasuries heading?
Yeah, look, I think that it's an interesting question because on the one hand, clearly the events of the weekend, the sort of, reducing of tariffs between China and the U.S., I think takes down recession risks. And so that's important. But it also means that on the other side, you kind of push back the possibility of Fed cuts. We've, pushed back the next Fed cut to something like the end of the year in December. And so I think there are sort of a couple of impulses here. One is, yes, we are expecting slower growth, but the inflationary impacts of the tariffs that have already been in place are likely to come through. And so I still think that the premium that you have at the longer end of the curve in treasuries is likely to prove somewhat sticky. I think the current levels, 4.5% thereabout, I think is the right ballpark. And if anything, as we go through the summer period, as we get somewhat higher inflation, as we realize the full contours of the fiscal plan going through Congress, I worry a little bit about the upside now more than the downside, given that recession risks have gone down.
But Kamasha, only one cut from the Fed towards the end of the year. Is that because they're focusing on inflation? They worry about inflation. And if actually they get it wrong, do they have to cut like quite steeply and aggressively and fast?
They certainly have the room to do so if, for example, the economic data slows much more drastically. If recession risks become important again, they have the room to cut much faster, as you say. But I think, we have taken those recession probabilities down. The market has taken those odds down, which is part of the reason why we think, growth, while still slower than last year, while still slower than trend, is going to hold up okay. That is going to mean that the Fed is going to focus both on inflation and that soggy growth picture and probably be on hold until the end of the year.
Okay, the viewer has been very patient. Let me get to that question. What's your view on the German 10-year now that the dust has started to settle post the German election? And, basically, where do you stand? Because there are some analysts calling a 4% level right after the package announcement. I mean, it was a rocky start for the Chancellor.
Right. I think the big shift was, of course, the decision in Germany to expand the fiscal envelope. I think that is the biggest issue for the German Bund. I think that's why we think, 10-year yields in Germany are going to head towards the 3% level, maybe just short of that by year end. But that's the direction of travel, and that really hasn't shifted. And I think it's important also in the context of the FX discussion we were having. I think for a decade or more, the policy mix in Europe was essentially one of fiscal restraint and easy monetary policy, which is a kind of currency negative mix. It looks like we are seeing a shift. We are seeing a shift towards slightly more expansionary fiscal policy, certainly in Germany, but you're also seeing the ECB coming up with a little bit more hawkish rhetoric that they don't want the rates to go down as much. And so that policy mix is much more Euro supportive at the same time as the U.S. is now aiming for the opposite. They're aiming for a little bit more fiscal restraint. The policy administration would like to see lower rates. It's a different question whether they will get them, but I think that's part of what's playing into the stronger euro, weaker dollar view as well.
Overall, that spending package from Germany is very large, but I don't think we'll see effects from before 2026, right? Sure. So that's a point. But will they really outweigh some of the negatives that could come from trade, but also what's happening on geopolitics with Russia?
I think it's, again, there is not a huge amount of premium in these assets from the geopolitics yet. So we've taken a lot of that risk out of many of the assets already. So I'm not sure that will be the sort of marginal driver. But I think you're right that, the proof of the pudding in Europe is going to be delivery. There is a proposal, there is a package, but when the spending actually hits the road, when the rubber meets the road, I think that's going to be the key. So we've done a lot of front running of that. I think that's why yields are where they are. But I think to get to that kind of higher 3% type level, I think you need to see the growth side pick up. You need the fiscal delivery to come through.
There's a lot, even on U.S.-China. I don't know whether what you do with renminbi right now, or whether you play it through yen or even Swiss franc.
I think that one of the biggest shift is going to be a gradual but controlled move weaker in dollar renminbi, as in the renminbi stronger. I think that we're going to head towards the 700 level. I think we're probably even going to go potentially below that. I think that China if you look at the strength of its trade balance, the fact that it has, a lower exposure to the U.S. than in the first trade war, if you look at the fact that the currency is undervalued both on a trade-weighted basis, but also especially versus the dollar, I think they can afford to have some appreciation in return for more reasonable trade outcomes. And I think that is the kind of, even if that agreement is not explicit, I think we will see something of that nature going forward. I think you've already seen that a little bit in the way that the fix has been moving slightly stronger in the next few days. But this is China. Nothing is going to happen in a rush. It's all going to be controlled. It's all going to be gradual. And so you're right that people are going to look to other currencies in the region to kind of express that view. That may be, Korean won. It was probably Taiwan a couple of weeks ago. So I would be quite ambitious about how big these moves can be. But I think it's not going to happen in the CNY. The CNY is going to be slow and steady.
Okay, sterling. We have to talk about sterling because we had a big week for the Bank of England. Yesterday there was the pension accord, the Mansion House. Where do we go with GBP?
I think GBP is going stronger from here. I mean, I think that, again, I think of sterling as a currency that requires the right mix of risk sentiment. I think it struggles a little bit if risk sentiment is under too much pressure. But the fact that we've seen that relaxation, I think, has helped cable go back up to around 133. Our 12-month target is 139. We think it's going to sort of move there. It's not that cheap anymore, the currency, to be fair, but we think it can overshoot if we are right in terms of where equities are going and where the overall sort of Bank of England setup remains, which at least till the end of the year, till the second half of the year, I would say till September, is still going to be on this sort of gradual cutting path. Beyond that, maybe rates become a better trade than the currency. But right now, we still think there's room for sterling to strengthen further.
So interesting. Thank you for joining us. That was, of course, Kamakya Trivedi, Global Head of FX Rates and EM Strategy at Goldman Sachs. We could have talked for another hour and a half to go around the world, but we'll get you back in. Now, President Donald Trump says the U.S. is exploring normalizing relations with the Syrian government after the toppling of President Bashar al-Assad.
We are currently exploring normalizing relations with Syria's new government, as you know, beginning with my meeting with President Ahmed al-Shara. I am also ordering the cessation of sanctions against Syria to give them a fresh start. It gives them a chance for greatness.
We were listening to that briefing together just about 10 minutes ago. The president spoke after a brief meeting, we understand, with the Syrian president in the Saudi capital, Riyadh, but also with the Turkish president, Erdogan, dialing into the discussion. Then the president went on to say that Secretary of State, Marco Rubio, would meet with his Syrian counterparts. This is on the back of possible deals, thin on details, but of course a memorandum of understanding that there will be deals between the U.S. and the Middle East. Now, Bloomberg has also learned that NATO allies have started putting together an agreement to significantly boost defense spending in a way that may assuage Donald Trump's demand to spend 5% of economic output on the military. Now, for more, let's go to Bloomberg's Oliver Crook in Berlin. Ollie, good morning. So what do we know about this plan?
Yeah, so listen, we're in a position here where NATO is basically needing to prove itself to the United States and is almost auditioning to the United States, and that audition will come into full force in June when you have the main NATO meeting that we're expecting Trump to attend in The Hague. But ahead of that, we have defense ministers meeting right now in Turkey in order to sketch out a plan of what that plan that they're going to present to the United States and to the rest of the world would look like. And what they would like to do is to satisfy the request from Donald Trump, which he has made repeatedly in the lead up to the election and afterwards, for 5% of GDP spent, up from that 2% minimum level up to 5%. So what they are discussing is basically raising that 2% level to 3.5% on sheer defense, then another 1.5% that will be a slightly more sort of wide definition of what it could include in terms of defense. It could be cybersecurity, it could be dual-use projects, those sorts of things, the kinds of things that are not just strictly speaking defense, but would satisfy the Trump administration. And again, the reason that this is so key, we obviously know all of the reasons why Europe is intensely dependent on the United States and the continued support of Ukraine from the United States. But in order to get that, and we heard that from Marco Rubio, we've heard that from all of the officials from the United States, and we've heard it from some of the signal chats that we also were privy to, that Europe needs to pull its own weight on defense, and this is their attempt to do so.
Ali, this comes as President Zelensky also says he wants to meet with Putin in Turkey for talks tomorrow.
Yeah, so listen, so Zelensky said no matter what happens, I'm going to be in Turkey tomorrow, so he's going to meet with President Erdogan tomorrow. There is a question about whether or not he will then go from Ankara to Istanbul to meet somebody, a representative from the Russian side. We do not know who from Russia could possibly attend these meetings. We think it's probably unlikely, from what I'm hearing, that it will be Putin himself. It could be Sergei Lavrov, the foreign minister, but this is all part of Zelensky's plan to basically demonstrate to the United States that Ukraine will never be the impediment to peace. And this is, in fact, what we heard from Zelensky yesterday, saying that if Putin doesn't come to Turkey, it will be a final dot and a demonstration that Russia is not ready to end the war. What he is trying to communicate to the United States is that it's Putin that is going to be the problem. It is Putin that is going to be the impediment to peace. And if he is able to convince the United States of that fact and convince Donald Trump of that fact, we know there is a draft bill waiting right now within the Senate that has been put forward by Lindsey Graham that would bring all kinds of new, fresh sanctions against Russian oil and gas that would really cripple Russia's ability to generate capital. I am very suspicious that this alone, if Putin were not to show up, would be enough for the Trump administration to turn on that. But this is all part of building the case on the Ukrainian side to say, listen, we're not the problem, Russia is.
Ollie, thanks so much. Oliver Crook there in Berlin. Meanwhile, French President Emmanuel Macron has urged the European Union to step up pressure on Israel over the humanitarian situation in Gaza. Now, for more, let's go to Bloomberg's Caroline Conan in Paris. Now, Caroline, thank you for joining us. President Macron accused Benjamin Netanyahu of shameful behavior in blocking aid to Palestinians, a toughening of language from the French leader.
It is kind of a toughening of the language, even though we know that Emmanuel Macron has already had very tough phone calls with Benjamin Netanyahu over the past few weeks. He said last night on primetime French television that he was very angry at Benjamin Netanyahu last time he spoke with him about the situation in Gaza. And in fact, Emmanuel Macron traveled to the border of Egypt and Gaza early April, where he said the situation there was very brutal, with Israel trying to block access of humanitarian aid to the Gaza people. He said last night again, the situation in Gaza is a humanitarian tragedy. It is unacceptable. And what Emmanuel Macron has been pushing for really over the past few months is the creation of a Palestinian state, the double state solution. This is something that actually he's been talking to leaders in the Middle East about. He had a phone call with Donald Trump about this when he was visiting his Egypt counterpart in April. And this is also something he's trying to push with Saudi. And this is kind of interesting in light of Donald Trump in Saudi, and Donald Trump saying that his dream would be that Saudi joins the Abraham Accords with Israel, and he's looking to expand the Abraham Accords to other countries. And in fact, Emmanuel Macron has been trying to kind of try and normalize the relations between Saudi and Israel. And in fact, France and Saudi are going to hold together a conference in New York in June about this possibility of a double state, Palestine and Israel solution. Clearly, last night there was a shift of tone and a possible reassessment of the European policy towards Israel.
Yeah, and Caroline, he made these comments in a wide-ranging interview last night. What did he have to say about some of France's domestic issues?
Yeah, he spoke for more than 3 hours, mainly international headlines, but clearly he was expected to announce a referendum, something that he didn't do. He kind of pushed this idea back to perhaps later this year, perhaps in the fall. What we know is not going to ask the French is a referendum on immigration. He ruled that out. He also ruled out a referendum on the retirement reform, because he really wants to hold the retirement age to 64 years old, a reform that he spent months to pass a couple of years ago. But the French are in favor of a referendum. They put security, debt, deficit at the top of their priorities. Having a referendum on debt and deficit is an idea that was also floated by the Prime Minister François Bayrou a couple of weeks ago. So that could be something, but of course the risk is that the French transform this referendum possibly into a plebiscite for or against Emmanuel Macron.
Caroline, thank you so much. Caroline Conant there in Paris. I'm going to Paris, so I'm looking forward to seeing you a little bit later. Now, coming up, the U.S. president looks to rewrite the rules on exporting AI chips to China. We'll dig into the details next. And this is Bloomberg. From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Welcome back, everyone. Now, Donald Trump has said he'll get rid of regulations on AI chip exports that were introduced by Joe Biden and introduce new rules aimed at limiting the progress of advanced technology in China. Let's get more now from Bloomberg's Tom McKenzie. Tom, it's so good to speak to you. How significant is actually Trump's plans to rewrite the AI chip curves?
Yes, so very significant, and particularly on the timing, given where he is in the Middle East, because the chip curves put in place towards the end of the Biden administration, pretty rushed, and faced a lot of pushback from corporates like Jensen Huang, and NVIDIA was very outspoken about the impacts that was going to have, and also pushback from some of the US partners and US trading partners and allies as well. And what that rule was, it was called a diffusion rule, put in place again by the Biden administration, which essentially had a tiered approach to who could get access to the most sophisticated AI chips. Within that middle range were Middle Eastern countries like Saudi Arabia and the UAE. That rule has now been suspended. The Trump administration is working on their own rules. They said the rule put in place by the Biden administration was unworkable and would impact the innovation for the US and impact their ability to be diplomatic as well with some of their partners. So they've got rid of that rule. What it means is that the UAE and Saudi Arabia now have access to those top-end NVIDIA and AMD chips, and we've seen a lot of deal-making in that space. The UAE could take ownership of more than 1 million NVIDIA chips, for example. NVIDIA also expected to supply about 100,000 chips to the Saudi Arabia. AMD as well, their competitor, also in the mix. So it's a massive change, hugely significant for Saudi Arabia, hugely significant for the UAE, and as well NVIDIA and AMD within that space.
Yeah. I'm still just looking at you in admiration that you said it correctly. Chip on
Finally.
trip, I can't say it. Meanwhile, Tencent has also reported earnings. How do they look like?
Yeah, look, China's most valuable company, so a gauge on the health of the Chinese consumer, but also a gauge on China's own AI efforts. And interestingly, they came through with revenues that were a beat, but in terms of operating profit and net income, a bit of a miss for Tencent. The parts of the business, so fintech and cloud, that are really most closely connected to the health of the underlying Chinese economy, came in pretty flat. Gaming outperformed. And interestingly, on AI, they did say, executives, they are starting to see tangible positive impacts to earnings as a result of their investments around AI, which they will be stepping up as well. Prosus, a major stakeholder, of course, in Tencent, the last time I checked, was gaining on the back of this news.
Tom, what about Apple partner Honhai?
So their quarterly results came in pretty solid, above estimates, but it's the guidance from Honhai, of course, the producer, large producer of iPhones, they major manufacturer for iPhones, for Apple, but also hardware that goes into the server and data centers around AI. So they have that AI exposure as well. And they actually cut their forecast because of concerns and uncertainties as a result of tariffs. We've heard a similar thing from Apple as well in terms of their expectation around sales. They've moderated their view on sales and also have accounted for some of the cost as well of the tariff impact. Hon Hai also now adding caution to that picture looking out towards the end of this year.
Okay, Tom, thank you so much. As always, a terrific roundup of all our big tech stories are Tom McKenzie. Now, Burberry earnings beat expectations. The British fashion firm also said it could cut as many as 1,700 jobs to reduce costs. Well, our very own Charlie Wells is here with an earnings update from the luxury sector. So, Charlie, I mean, it's basically, I mean, Burberry seems to be going through a big transformation. Investors like it.
Investors this morning,
for now.
Yeah, they like it for now. This morning, so shares are up as much as 10% this morning on the back of this report. But it really does speak to kind of a company in transition. We had that news about the job cuts, but also when you dig into some of these numbers, you get the sense of this transition. You get some, you got a beat, for instance, on like-for-like sales from these same stores. But it was still a decline. And so this just shows the challenge that this company is in, decline of about 6% from the same period the year before. You get the CEO putting a statement out this morning saying, we are in the early innings, in the early stages of a transition here, and talking about a more difficult macroeconomic background. Now, that could be really challenging for Burberry because they've been trying to position themselves in a little bit more of an accessible space.
Yeah, I have to say, it's been a tough ride for Burberry. They've changed creative directors, they've changed chief executive, and they haven't really quite figured it out, but let's see if, of course, the new CEO, Joshua Schulman, can turn it around. Richemont. So this is hard luxury, right? I mean, it's basically the watches.
Absolutely. So it's kind of, from Burberry today, we got very much kind of exhibit A from the soft luxury space. Yeah. Richemont, we're going to get exhibit B from the hard luxury space. And if you take a look at how these kind of different parts of the luxury space have been performing, soft, not great this year, hard, pretty well. And we're expecting a solid report from Richemont. But one risk that this company has, and they're headquartered in Switzerland, is that dollar depreciation we've been seeing. So that could be a headache.
Okay, I mean, it's really interesting because there's a lot, I always go to like Andrea Felsen. I'm like, what do you want to buy? Because it's a good benchmark of who does well and who doesn't.
She has such a good sense of kind of what the trends are, what the consumer wants. And I think that's what these firms are trying to navigate right now, is this kind of difficult, uncertain moment. But it's seeming like that high-end consumer who can kind of spend in either kind of bad or good economic weather. That's what's really benefiting firms like the Richemonts, but we'll have to watch on Friday.
Yeah, Charlie and I are going to have our own benchmark. If you don't want the bag, there's a good indication the share price may not go up. But Charlie, thank you so much. Charlie Wells there with the very latest on luxury. Now back to our top story. In the last hour, President Donald Trump has said that the U.S. is exploring normalizing relations with Syria's new government after the toppling of President Bashar al-Assad. Now Trump also spoke about relations with partners in the Middle East during a meeting with Gulf state leaders in Riyadh.
I've seen such progress. It's really incredible. I've also seen great unity and friendships. I've spent a little time with you just before this, and I've seen tremendous unity, tremendous friendship, and the whole world is watching the Middle East, and many are watching with envy. You have something very special going on.
Well, of course, we'll have plenty more on the visit of Donald Trump to the rest of the Middle East. And then we also have our Qatar Economic Forum tomorrow. The other story we're watching out for, and this is away from earnings, away from geopolitics, in the banking sector. Now, a dozen former Credit Suisse bankers were unlawfully stripped of their bonuses when UBS bought its collapsing rival. Now, this came out today. This is according to a Swiss court, and that's what they said in a verdict that could pave the way for fresh lawsuits from hundreds more employees over unpaid compensation. I know it's something that our viewers watch very closely. Again, the court said the government's decision was wrong in its application of the banking law. The court also said that it was disproportionate and it does not demonstrate that the affected managers caused excessive risk or jeopardized Credit Suisse. Now, in other news, don't miss our exclusive interview with the chief executive of the European defense and aerospace giant, Leonardo. That's airing tomorrow on Bloomberg TV. Up next, Bloomberg Brief, and this is Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Is this a negotiation or the new rules of the game? It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Good morning from our global headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. AI deals galore. President Trump clears the path for tech deals in the Middle East, with chip makers planning to spend billions of dollars. And more deals stateside. House Speaker Mike Johnson says that Republicans could reach a compromise on the state and local tax deduction as early as today. And back in black, U.S. stocks erase this year's drop as trade tensions cool. And that turnaround in U.S. stocks, it has been really remarkable. Bespoke noting that we recovered the 15% year-to-date drop in less than 6 weeks. That's the fastest pace of a turnaround since 1982. Yesterday, it was about the AI deals with Saudi. It was about cooler than expected CPI. So we were off to the races. But this morning, very calm. Little change for both your S&P and NASDAQ futures session. Russell 2000 futures, those do underperform after a big day for the index yesterday. Your bond market also a bit calmer, but we are finally seeing bond yields on the front end below 4%. We priced out more Fed cuts, only about 2 this year. But the 30-year yields, those did close at the highest since January. So not all of this bond market acting the same relief that we've seen. By the way, the dollar also not able to get back into the green for this year. It is still down on the year despite what equity is doing. South Korean officials moments ago confirming that FX currency had been part of the talks with the U.S. Are we going to focus on dollar policy out of the White House instead of trade as we move forward? All right, that's your overall markets. Let's get some stocks to watch this morning. With that is Bloomberg's Joe Easton. Good morning, Joe.
Hey, Danny, so we are expecting to see a third day of gains for NVIDIA today. That stock rising at around 2% in the pre-market. It gained 10% in the previous 2 sessions as Trump does make his deals over in the Arab Emirates and also, but we have got Intel on the screen there. But bear in mind, NVIDIA is ticking higher. Take my word for it on that one. We're seeing that gain of around 2% this morning. Intel slightly lower meanwhile. Then we've also got a bit of a clothing theme. American Eagle absolutely slammed in the pre-market, pulling its guidance alongside a few other companies that we've seen doing a similar thing, kind of due to the trade war on that one. That stock down 14% at the moment. Then one I'm more familiar with, we've got the owner of Calvin Klein and Tommy Hilfiger, PVH. That one's upgraded over at Jefferies, who reckons those brands are doing a bit better with young people. And I think we're going to bring up NVIDIA finally on their final one on that screen there. There we go. I knew I hadn't missed that or misread that one. We're up almost 2%, or NVIDIA, following those deals in the Middle East made by Trump. Back to you, Danny.
You got to show the people what they want, and that's what NVIDIA is doing every morning and this morning. Joe, thank you so much. We'll catch up with you later in the hour. Bloomberg's Joe Easton. And speaking of this hour, in just a few moments, we're going to be speaking to Callum Pickering of Peel Hunt. Later, we'll be catching up with Marvin Lowe of State Street. Two conversations you do not want to miss. Well, the S&P 500 has erased its losses for the year, but many still looking cautiously for 2025. Callum Pickering, chief economist at Peel Hunt, writes the Trump administration is walking back its tariffs gradually through a series of deals, but tariffs and barriers to trade will remain appreciably higher than pre-Trump, with significant negative economic consequences for the U.S. economy. I'm pleased to say that Callum joins us now. Callum, great to see you. So how much did Monday change your economic outlook for America?
Well, it hasn't changed it much. I think the assumption, or dare I say, the strong hope, was that tariffs would come down between the two largest economies in the world. The problem I have at the moment, and this is the sense I get when I speak to people, is, okay, risk markets, equity markets are moving up, but if I look at consensus expectations for US real GDP for this year and next year, they're still coming down. I see inflation expectations for this year and next year still going up. And so there's a bit of a contradiction here. Markets are pricing in hope that things will be okay. But actually in the numbers, analysts are telling us we're becoming increasingly worried. And I think part of this is just this, at the moment, this gap between the hard data coming out of the US, which is essentially pre-tariffs, and that the last CPI print is a good example of that, and the soft data, which still looks worrying. And so my nervousness over the next few weeks comes from the fact that if the hard data start to catch up with the weak soft data, if these analyst expectations for weak growth start to play out, then you might find actually that suddenly risk markets come down a little bit again, and then we go through another period of volatility.
Callum, you read my mind, because that's where I wanted to go, that we can live on this hopium because it's not showing up in the data yet. How long do you assume that it will take for the hard data to actually start to reflect some of the tariff uncertainty, some of the companies' freezings of a capital expenditures plan? When does that finally flow through and maybe throw a wrench into the equity market rally we've seen?
Well, hopium, I like that. That's a great way to describe it. The thing is with Q1 was bad and it was distorted for all sorts of complicated reasons. At the moment, it's early into Q2. We don't have much data for April for real economic activity, but I do expect to see it through May and through June. We should start to see weakness in consumer spending. We should see weakness in capital and capital expenditure plans. But the thing that people should keep in mind here, there's a structural component, which is the cost of tariff policy, which is yet unresolved, to be clear. But then there's this cyclical risk coming from the fact that even if we abstract away from these tariff policies, the likelihood that the US economy would just moderate this year was pretty high anyway. US consumers were saving almost nothing last year. You had markets pricing in huge amounts of good news. You had 2 years of extraordinary fiscal stimulus under the Biden administration that was due to wear off. And so what you actually have is you have this cyclical downward momentum and then these structural downside risks. That's a lot of pain potentially to come through to the US economy. My base case is actually not recession. I see about a 35% risk of that. The lesson from, say, the UK Brexit was actually economies tend to muddle through. The US economy is very dynamic, but I still find this hopium that you mentioned is just the theme in markets, and I don't see how it's very sustainable at this stage.
Does that mean we're misplaced pricing in just 2 cuts from the Fed this year, Callum?
That's a great question. I think the Fed, in all likelihood, would prefer to be cutting interest rates given the downside risks and given the fears of recession. But you need to get through this very likely immediate hump in prices as firms try to pass some of these tariffs on to consumers in the US. And that puts the Fed in a very difficult position. It's dual mandate, maximum employment and price targeting. Stable inflation is on a collision course with tariff policy. The last thing the Fed wants to do after this very bitter period of inflation that we have just had is start cutting interest rates as prices are rising. Keep in mind, the Fed normally reacts more strongly to downside risks to growth and employment than upside risks to inflation. So this is a very unusual situation. My hunch is we'll get 3 cuts this year. Once the Fed starts to move, probably in Q3, they'll start to move quickly, but at least for now they have to sound hawkish.
Well, what we saw in the data yesterday, Callum, was this fear that Priya Misra from JP Morgan talked about us yesterday, the idea that services inflation starts to decline and goods inflation starts to reaccelerate. To her, that was a red flag and a warning that consumers are soon going to have to make hard choices, and you get some sort of demand destruction coming in to this economy. Is that a concern for you too, that flip for where the inflation from the data is coming from?
That's absolutely right. So if we get significant goods price inflation, especially in inelastic categories, those are the essential products, not discretionary spending, just essential products. And this is happening as consumers are turning fearful and as broad financial conditions tighten. What you'll find is consumers will be forced to reallocate spending from discretionary services towards non-discretionary goods. That actually may make the arithmetic a little bit easier for the Fed, because if they can say, well, look, services prices give us a better handle on underlying inflationary momentum, goods prices are giving us a signal to this self-inflicted inflation shock, actually, we can look through this a little bit and we can start to sound a little bit more dovish. But for me, the key question for the Fed is over the next 2 to 3 months, which breaks worst, inflation to the upside or economic data to the downside? Ultimately, that will decide the trade-off that the Fed makes between its inflation and employment mandates.
Callum, how difficult is the data going to be to understand over the next few months, especially as we're in this 90-day pause and there are reports of shipments taking off nonstop, about ports all of a sudden being overrun? The assumption is that they will be, to get ahead of what happens after 90 days. Is the data going to be really hard and difficult to parse through?
It will be extremely difficult to parse through. What I would recommend is just making an idea, come up with a concept of something like core GDP. I think Bloomberg actually came up with some kind of indicator like this. It's very useful. So that's consumer spending, it's parts of business investment, it also includes some government spending. That gives a handle on the domestic momentum in the US. That probably gives a better guide because it takes away some of these trade and inventory distortions. But what we're likely to see is 2 things. One, wild gyrations in imports and exports as firms try to guess and move ahead of any potential rising tariffs after this 90-day pause. But also what I describe as event horizon risk. This is where the administration sets up these event horizons where we can't do anything until we know what kind of world we're in. Is it world A or is it world B? And there's very little overlap between those 2 worlds. And so as we face these rolling event horizon risks, the incentive is for firms just to pause investment. It's for consumers just to pause big ticket. And so these 2 things happening, these gyrations linked to tariffs moves, but also this event horizon risk, complicate the economic story enormously.
Callum, this was an absolute masterclass. Thank you so much for joining us this morning.
Well,
that is Callum Pickering of Peel Hunt. Let's get you now some other top stories that are trending on the terminal this morning. Tencent's revenue beat estimates after growing its gaming and social media portfolio through a persistent Chinese economic slowdown. Revenue for the 3 months ended March rose to $25 billion. Its net income increased by 14%. Tencent has benefited from the Chinese tech renaissance triggered by DeepSeek, with its apps gaining users since integrating with DeepSeek's offering. The U.S. and South Korea have agreed to continue discussions on FX policy. That's according to sources. The South Korean Deputy Finance Minister met with the Assistant Secretary for International Finance in the U.S. Treasury Department on May 5th. The dollar is now declining as signs grow that the Trump administration is shifting focus from trade to exchange rates. And a Swiss court has ruled that the government's decision to strip bonuses from a dozen former Credit Suisse bankers was unlawful. The country's finance minister had issued an order following the bank's rescue by rival UBS in March 2023. It told Credit Suisse to cut bonuses for its executive board members by reducing them by 50% for managers 1 level lower and 25% for employees 2 levels down. Coming up, the Trump administration clears the path to AI expansion between the U.S. and Saudi. We'll have more on the deals and Trump's visit to the Middle East. That's coming up next.
Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday, only on Bloomberg. Context changes everything. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
I've seen such progress. It's really incredible. I've also seen great unity and friendships. I've spent a little time with you just before this, and I've seen tremendous unity, tremendous friendship, and the whole world is watching the Middle East, and many are watching with envy. You have something very special going on.
President Trump speaking in Riyadh moments ago as he prepares to finish the first leg of his Middle East tour. The Trump administration has been clearing the way for allies in the Persian Gulf to expand their capabilities, and big U.S. tech is capitalizing on the opening. Humane, a newly formed firm coming under Saudi's PIF, is at the center of the slew of deals with NVIDIA, AMD, Amazon, and others. Let's get more details from Bloomberg's Stuart Livingston-Wallace, who leads our coverage in the Middle East. Stuart, just what did we get out of the Middle East visit so far? It has been deal after deal.
Yeah. I mean, the scale of it is really quite impressive. And we haven't quite totted up the numbers, and there's a caveat here in that many of those deals are not necessarily finalized, importantly. Secondly, there have been some worries expressed back in Washington from some of the hawks, particularly around, concerns about China getting access to some of this tech. But at least on the face of it, we're talking about hundreds of billions of dollars of deals. A very, very significant part of that is the tech side. So the so-called tech diplomacy kicked off in full swing. We saw basically every tech leader on the planet show up in Riyadh yesterday. And the mood on the ground was pretty jubilant, because this has been a fraught issue for a number of years. So assuming all of those issues can be resolved and that everyone can get on board with it, I mean, it does signal a major shift in terms of where that tech is going to sit in the future. And again, if all those deals come through, then basically the Arabian Peninsula pushes itself up into a similar sort of position that the US has and China has in terms of AI.
What about the investment coming the other way? The President Trump announcing that Saudi would invest about $600 billion in the U.S. Paul Donovan of UBS pointing out that that's about 60% of Saudi's GDP. What might that look like, Stuart?
It is, and there were promises that they're going to try and get it up to $1 trillion, which would be basically all of GDP. So again, some caution with those numbers. Some of those will be previously announced deals, some of those deals will never happen. But I think whatever the final number, again, the scale of those deals is incredibly impressive. I suspect a large number of them will come to fruition. It is absolutely in the interests of the peninsula, specifically Saudi Arabia and the UAE, to get their economies away from oil or the dependency on oil. They know that's going to run out eventually. And there's a really serious push now to expand both their industry, to expand their technology, to expand their general involvement in global trade in something that doesn't involve energy. So, certainly from the side of the Arabian Peninsula, there is great appetite to do this.
Stuart, before we let you go, just quickly, Trump also made some news in terms of U.S. relations with Syria. What did we get there?
I mean, again, quite surprising. I mean, that was the sort of the moment in his rather long speech yesterday in Riyadh where he got a standing ovation. He was clearly encouraged to do this by the Saudis and others because this is the way they see it, that for all the questions there are about the leadership in Syria, and obviously the background is in terrorist organizations, they are very keen for Syria to come back into the orbit of the Arab world and to basically uncouple it from Iran. So for many years under the former regime in Syria, it was backed by Iran, it was supplied by Iran, and that's ultimately what they're trying to get away from. So that intersects almost perfectly, I think, with Trump's intention here, which is to create a counterweight on the Arabian Peninsula going forward, a counterweight against Iran, so that US involvement in the region doesn't have to be on the scale that it traditionally has been in the last couple of decades.
Stuart, thank you very much for that excellent update. That is Stuart Livingston Wallace. Now let's turn back to Washington, D.C., where lawmakers have also been busy. House Speaker Mike Johnson told reporters last night that Republicans could reach a compromise on the state and local tax deduction today. Let's bring in Bloomberg's Joshua Gallo on this. Josh, so the SALT tax breaks looks like it might be coming up today. What might we expect from a deal?
Well, it looks like Speaker Johnson is prepared to try and push through a deal that would raise the cap from currently $10,000 to $30,000 for individuals making up to $200,000 a year. That would, of course, be tripling it from the 2017 deal. But this is a really thorny aspect of U.S. tax policy, and it's highly politicized. The reason is that it mainly affects areas that like California, New Jersey, New York, with very high property values and relatively high tax brackets. So people really want to be able to deduct more of those state and local taxes from their federal taxes. The problem is, of course, the Trump administration is looking for revenues to pay for their overall tax cuts, so that's not helpful for them. From a political perspective, of course, Trump is the one who really wanted to cap this back in 2017 because it hits primarily Democratic states. So, but now he's got to help his representatives in those states that have been hurting from that cap, and also sell it politically in areas that are less prosperous, that are going to see cuts to things like Medicaid and food assistance, while at the same time seeing breaks for areas like affluent areas like California and New York.
Well, this has been an extremely thorny issue, Josh. If House Republicans are able to come to an agreement on this, does this suggest that there is room for a more easy passage of, in total, the big, beautiful bill?
I think so. I mean, Speaker Johnson wants to get this over to the Senate soon. He wants it out of committee, and his aim is to get it to Trump by 4th of July. That, of course, is a pretty tight time frame. That's only about 7 weeks from now. So, and a lot needs to be done. But this is one of the biggest sticking points. If they can come to an agreement on the state and local tax deduction, they will have gotten past a very big hurdle in getting all of their members in those key states on board. And they have to do that because they're proceeding with, budget reconciliation, where they can bypass a process that would have to get Democrats on board. But in order to do that, they need all of the Republicans to vote with them.
Josh, thank you so much. That is Bloomberg's Josh Gallo with the latest in Washington, D.C. Now, coming up, we're going to take a look at what else is making headlines around the world. We'll peep into the front pages. That includes China's attack on the U.S.-UK trade deal. That's coming up next on your Bloomberg Brief.
In case you missed it, on Bloomberg Open Interest, how much would it cost to bring production here, Rebecca? I mean, what kind of upcharge would you be looking at?
There is no handbag infrastructure in America anymore besides a couple of small factories in New York City. So not only would we have to build a factory that could make the amount of units we're trying to make, but we'd have to bring back hardware manufacturing, bring back tanning and leather. I mean, these are all things that are purchased overseas and assembled. You know, if you want this to really work, give us grants to build factories, give us several years of tariff breaks in order to make these things happen, and then we'd love to make in America. It just right now, if I were to switch everything to America, my price would double, and my consumer is not here for that. As small businesses doing under $50 million, you know, keep us alive. We are employing millions of people collectively and affecting livelihoods across the U.S.
Don't miss Open Interest live weekdays.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Let's take a look at the front pages this morning. First up on the Washington Post, they lead with President Trump announcing plans to lift sanctions against the Syrian government and a willingness to negotiate with Iran. Trump also said today he'd explore normalizing relations with Syria. It signals a reordering of foreign policy, which there are no permanent enemies. Next up, the Wall Street Journal has this, that Health Secretary RFK Jr. bid to label pesticides as a potential cause of health problems has seen some pushback from the White House. Trump had pledged on the campaign trail to investigate pesticides as part of an effort to win support from Kennedy backers. And finally, on the FT, China has criticized a trade deal between the UK and US. Beijing said it was a basic principle that agreements between countries should not target other nations. It has also warned countries against signing trade deals with the U.S. that threaten Chinese interests. All right, as we head to break, let's get a check on currencies. The won rising this morning after South Korean officials confirming that FX talks were indeed part of the talks with the U.S. The dollar overall weaker this morning. Coming up, we'll catch up with State Street's Marvin Lowe. This is Bloomberg.
What would it mean for India to host the Olympics?
Linda, I don't think it's my dream alone. I think it's a dream of 1.4 billion Indians to see the Olympics being held in India. I think once sport takes over, the transformation will be seen, not only in the lives of the youths, but in the economy of our country. India is one of the biggest centers for digital usage, and 1/3 of the viewership of the Olympic channel comes from India. So India as a sporting market is huge.
Countries which have hosted the Olympics have always grappled with the issue of infrastructure, for instance. Building it is one thing, maintaining it is another. How can India do it differently if it were to host the Olympics?
So I think we're talking about innovation and sustainability. And I think the same holds for holding the Olympics. What if you look at a sustainable model? What if you look at refurbishing old stadiums, reusing what we have? So I think the move has to be a sustainable move.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bring you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. AI deals galore. President Trump clears the path for tech deals in the Middle East, with chip makers planning to spend billions of dollars. And more deals stateside. House Speaker Mike Johnson says Republicans could reach a compromise on the state and local tax deductions as early as today. And back in black, U.S. stocks erase this year's drop as trade tensions cool. And it has been a remarkable rebound for U.S. stocks, undoing the 15% year-to-date losses in under 6 weeks. Bespoke pointing out that that is the fastest recovery since 1982. We're unchanged this morning for both the S&P and NASDAQ futures. Your Russell 2000 futures a little bit weaker, down by about 0.2 this morning. It was excitement over softer CPI tech deals in the Middle East yesterday that had us pricing in just 2 Fed cuts for this year. For now, that brought front-end yields below 4%. We're below 3.99 this morning, down another basis point. Your 10-year little change, but that 30-year yield stays stubborn. It closed at the highest level since January yesterday. And you can see on the bottom of your screen the dollar week, that unable to recoup the year-to-date losses despite what the equity market is doing. Okay, let's get some stocks to watch this morning. With that is Bloomberg's Joe Easton. Hey, Joe.
Hey, Danny. So there's strength in the chip makers once again following news of these deals over in the Middle East. Nvidia set for a third gain. We've had a 10% rise in that stock over the past few days, and we're up another 1.8% in the pre-market, given news of that deal with the UAE. And then Supermicro, smaller company, but up almost 8% on news of a pact with Saudi Arabia. Both of those moving higher. Then in terms of the clothing stocks, American Eagle Outfitters absolutely slammed in the pre-market this morning. We're seeing that one down close to 15%, pulling their guidance due to consumers cutting back on shopping and the weakness in consumer sentiment, according to the company. Then another look at the owner of Calvin Klein and Tommy Hilfiger, one I'm a little bit more familiar with. We don't actually have American Eagle over here in the UK anymore, but that one up 2.7% as Jefferies recommends buying due to strength among younger consumers, according to the broker. That one rising 2.7% in the pre-market this morning, Danny.
Joe, even if it was in the UK, I can promise you it is not for me and you, the demographic of American Eagle, so you're not missing too much. Joe, thank you so much for joining this morning, Bloomberg's Joe Easton. Now, State Street's Marvin Lowe has been weighing in on the latest trade developments, and of that, there have been a lot. He writes, quote, "It does appear as if the administration has shot its bullets, and the worst case is now part of the market narrative. Given the much cleaner positioning that investors now maintain, we should be able to build on risk assets, although a period of consolidation comes first." I'm pleased to say that Marvin will join us for the rest of the hour. He is Senior Global Macro Strategist at State Street. Marvin, great to see you.
Great to be here.
All right, so a period of consolidation first, and then some gains. How are you thinking about where we move forward from here?
Yeah, I mean, a challenge really is that we've recouped so much in such a short period of time. So, you know, everyone's clearly looking at the statistics that we are now flat for the year for the most part. But don't forget, during that period, earnings for the year have come down, and a lot of that has come out of the first quarter conversations with companies that, you know, there's just a lot of uncertainty around it. But the general trend is that it's going to be weaker from an earnings perspective than when they thought at the beginning of the year. So the fact that we're actually back to kind of that level playing field means that we've expanded multiples to get here. So, really one has to look at whether or not it should be as broad-based as it is. And then you've got other asset classes that are not necessarily recovering as aggressively. And are there messages in that? Kind of having said that, we have certainly come off the cliff. There's an opportunity to continue to build on risk, but I don't necessarily think that it's as all clear as kind of this really strong rally that we've seen over the last couple of weeks signifies.
Well, the dollar's certainly been one of those notable asset classes that hasn't come back with the rest of the equity market. You ask if there's a signal in it. Is there a signal in it?
You know what? Certainly it is. A weaker dollar has been, I believe, one of the goals of the administration. It's not necessarily a bad thing, particularly if it could be done without a lot of the turmoil that kind of was associated with it earlier during the volatility. But kind of having said that, with tariffs, a weaker dollar, both of them equal higher prices. So, this kind of inflation story, even though we've got a decent CPI to kind of grab onto now, is still a story that's really in flux.
I want to talk about the inflation, but first on this idea of a still weaker dollar. Does that cap some of the gains in the equity market? Because for all of us sitting here in America, you're back into the black for the year. But if you're a foreign investor and you haven't hedged your dollar exposure, you're still under pressure at the moment because of that weaker dollar. Does that prevent foreign flow from coming into the U.S.?
Not necessarily. There is this trend that I kind of see where it's easier to buy U.S. companies than it is to buy the U.S. government. And the U.S. government is really encapsulated in the dollar. It's encapsulated in Treasury securities. And we're seeing the power of U.S. corporations make their way in kind of through a lot of these Saudi agreements. Having said that, do you go in and buy U.S. assets without hedging? And if you ultimately do hedge those assets, you wind up with a weaker currency as part of that. And one of the big trends that we saw leading into this year was a very, very low hedge ratio relative to historic standards. Because the strong dollar, U.S. exceptionalism, there was no reason to hedge it. You're starting to see kind of cracks in that, and it does have an impact on the currency for sure.
Back to the idea of inflation. There had been a thought, and Anna Wong from Bloomberg Economics has been leading the charge on this, that if you have deals or at least pauses, it might be more inflationary because you have a stronger economy, people can spend more, and you get companies passing on. Plus, you have a tax bill that isn't as restrictive as most had feared. So the net sum of what we've gotten from this week is a more inflationary environment. Would you agree with that?
You know what, to a certain degree, it does create kind of a stagflationary type of concern. That's one side of it for sure. And the other side of it is confidence, just whether it's corporate confidence, consumer confidence. If given the means, I do believe the American consumer is one of the things that we can count on. But yes, having said that, you've got this impulse where people are rushing out to theoretically beat this tariff. And having these pauses, having these start on, start off type of environments just really is incredibly challenging for businesses that are planning. And that's kind of the soft data that we're all waiting to see if it actually makes its way into the hard data. Remember, soft data is generally considered leading, hard data is generally considered lagging, and there's a reason we have those terms for that.
So if the hard data is going to be lagging, when does it show up, and what does that mean for risk markets that have been very happy to price it in as if it will not show up?
Yeah, for sure. You know what? I think it takes fairly significant events, unless all of a sudden the administration changes its mind. Go back to the reciprocal. We'll go back to the board and say this is the way we're going to start approaching things. If we don't get a shock like that, and we get kind of these on and off, and then these various carve-offs, it's going to be fairly difficult to get a sense of how long-lasting and what the ultimate level is. But you do have things like the debt ceiling, which will create a lot of liquidity kind of situations where ultimately, if the government has to issue several hundred billions of dollars in debt to kind of make up for their piggy bank, which they've been using, that money has to come from somewhere, not necessarily from a yield call, which I also do think that there's ultimately a yield call, but when you need to reallocate money and the pool of liquidity becomes a little bit more scarce, then you see what people want to own and what people don't want to own. Right now, there's a decent amount of liquidity in the system, and we've got kind of a reprieve from what was a fairly challenging tariff trade environment to get over. you know, it's natural for people to get excited again.
Well, the long end certainly has not been able to come down to the same extent as the front end. Obviously, you get a repricing of the Fed. How much of that is, all right, the trade thing, we seem to be walking back on that. That seems to be normalized. The next source of attention for this market needs to be deficits.
For sure, for sure. I mean, near and dear to my heart, you know, spending a lot of time on the fixed income markets, really spending a lot of time in thinking how much compensation you need to go out the long end. Really, the two asset classes that have struggled to kind of come back from a lot of the turmoil, you know, if we're looking at it from a year-to-date perspective, we're looking at it from a Liberation Day perspective, it is yields and it is the dollar. And again, both of those are kind of the most directly tied to what buying the U.S. government means.
Does that suggest then that there still is a lack of trust, that there's been some sort of damage done from the volatility in policy we've seen?
Yeah, you know, I think that's an easy narrative to grab hold of. You know, can we put the genie entirely back in the bottle? I think that other countries are approaching relationships with the U.S. with more of a jaded eye, and I think that ultimately makes its way into kind of the way we approach investments, for sure.
All right, Marvin, you're going to be sticking around with us
Excited.
for the rest of the hour. I'm very pleased to say Marvin Lowe there is State Street. First, let's get you some other top stories that are trending on the terminal this morning. Now, Tencent's revenue beat estimates after growing its gaming and social media portfolio through a persistent Chinese economic slowdown. Revenue for the 3 months ended March rose to $25 billion, with its net income increasing by 14%. Tencent has benefited from the Chinese tech renaissance triggered by DeepSeek, with its apps gaining users since integrating with DeepSeek's offering. A Swiss court has ruled that the government's decision to strip bonuses from a dozen former Credit Suisse bankers was unlawful. The country's finance minister had issued an order following the bank's rescue by rival UBS in March 2023, telling Credit Suisse to cut bonuses for its executive board members by reducing them by 50% for managers 1 level lower and 25% for employees 2 levels down. NATO allies are working on an agreement to significantly boost defense spending. Negotiators are making progress on a path to achieve 5% of GDP on defense and defense-related spending by 2032. The agreement would mark the biggest spending increase by Western allies since the end of the Cold War. Coming up on the show, a floodgate of deals. President Trump secures investment in the U.S., clears the path for big tech to cut AI deals in Riyadh. We'll have more on the president's visit coming up next. You're watching Bloomberg Brief.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
In case you missed it on Balance of Power.
If we're going to get all this revenue from tariffs, why would the president be pushing for higher taxes on anybody? Because our understanding is for the wealthy, he's looking at a new rate of 39.6%, and I thought the Republican Party didn't stand for that kind of thing.
Well, you realize that the tariff revenues doesn't count toward the reconciliation numbers. Don't ask why. I can't understand why. We're running at like 25 billion a month, and they're not counting it, but we'll leave that aside for another day. This is Washington. They have their own accounting practices. So the president's trying to make sure he gets no tax on tips, no tax on overtime, and no tax on Social Security. And if he says, look, the richest Americans, remember, he cut it from 39.6 to 37. So if he just goes back to what he did last time, you know, I'm in favor of that. I think it's smart.
Don't miss Balance of Power live every weekday.
Africa,
a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
I've seen such progress. It's really incredible. I've also seen great unity and friendships. I've spent a little time with you just before this, and I've seen tremendous unity, tremendous friendship, and the whole world is watching the Middle East, and many are watching with envy. You have something very special going on.
President Trump speaking in Saudi there moments ago as the first leg of his Middle East tour winds down. Big tech at the center of President Trump's deal-making in the Persian Gulf. The newly formed firm Humane, coming under Saudi Arabia's investment fund, is at the center of a bunch of deals with the likes of NVIDIA, AMD, Amazon, and others. For more, we are joined by Bloomberg executive editor for tech, Peter Elstrom, and State Street's Marvin Lowe is still with us. Peter, a lot of deals. Break them down from us. What did we get over the past 24 hours?
Well, this is a quite significant change in U.S. policy around technology exports. The Biden administration had been implementing a pretty complex set of regulations where they were stopping the export of a number of different things, including NVIDIA chips that are used to train these AI models. What we've seen now is the Trump administration is essentially throwing out that framework. They formally repealed this AI diffusion strategy that the Biden administration had been using, and instead they're cutting these bilateral deals, including what we saw with Saudi Arabia, where they're trying to allow more of an export of those NVIDIA chips and other kinds of technologies to countries depending on certain circumstances that they negotiate. So in this case, you've got a quite big deal where this AI company in Saudi Arabia, Humane, is going to be able to buy NVIDIA chips and AMD chips. They're also getting other kinds of support from the U.S. We think this is part of a broader strategy as the Trump team goes through the Middle East. We expect more deals of this type as they go to the UAE in particular.
Peter, what about the security concerns? Part of the reason some of these chip sales were capped was for fear that they'd end up in the hands of China. Is there anything being done to address those concerns specifically?
Yeah, that's a very good point, Danny. That's totally unresolved at this point. So at a high level, they're saying they want to change the strategy and open the door to more exports of AI chips in particular, but they haven't worked out this very thorny issue of how they're going to deal with the China risks inherent here. In particular, in the past, they've been concerned that either the AI chips are going to get diverted from the Middle East into China, or companies are going to be able to tap into AI capabilities through cloud computing services within the Middle East, and they have not resolved that. There are tensions in the Republican Party at this point about whether the Trump administration is going to be able to do enough to mitigate those risks, or whether they still have to resolve them in some sort of way other than that.
Hey, Peter, question for you. Looking at the deals that were cut, particularly on the high-end semis, is it a bit of water in the desert, if you will, in that the kingdom has been restricted from owning this, and ultimately anyone that wants to build these AI models want to own more of it? But kind of this AI story, as it evolved over the last year and a half, has been an uplift for a lot of different companies. But can it expand beyond just these high-end semis, particularly after the kind of the DeepSeek shock that we got a couple of months ago?
Yeah, that's a very good question. Really, the development of these AI technologies has been led by the American companies and the Chinese companies. I think you have those two very powerful poles of AI development. Now you're seeing other countries try to jump in here and develop some AI capabilities that will be beneficial locally, and perhaps they want to be able to compete globally too. As you mentioned, Saudi Arabia has a long ways to go to catch up just to compete on some of the most basic levels. The UAE has been investing for a bit longer. We do expect G42 in particular to be able to get access to a lot more chips than in the past. We have a scoop out right now talking about how the number of chips that they want to import into the UAE is going to be quite significant, roughly 4 times as much as they would have been able to buy in the past. So I think they probably have a bit more of a head start in terms of developing these capabilities. But both of the countries have a long ways to go to be able to compete on a global scale.
So after the China announcement started to come out, we saw NVIDIA pull back on its expectations with regard to how much revenues ultimately can collect from that part of the world. Does this, for the most part, offset a lot of that? Is that kind of where the commentary is going to go, that while we still have China concerns, we've got this really big wellspring that the advanced chip makers can tap into?
Yeah, you make a very good point. NVIDIA had been barred from selling its H20 chips into China. That was certainly a setback for them. They were quite vocal in their opposition to those new restrictions. They're worried about competition domestically from companies like Huawei in particular. This is directionally, it's certainly a benefit for them. They're going to be able to sell more into the Middle East to some of these customers. You see in the share price, the NVIDIA stock was up about 11% over the past couple of days as investors anticipate that they are going to be able to boost some of their revenues with sales into parts of the world like the Middle East.
Peter, thank you so much for joining us. An excellent roundup. That is Bloomberg's Peter Elstrom. And Marvin, as you point out, there has been a lot of excitement about these deals. NVIDIA surely took off yesterday. How much of that do you take with a grain of salt? Because we saw in Trump 1.0 that just because deals were announced doesn't always mean that they follow through.
Yeah, for sure. And, the size of the deals that are being promised is, a significant portion of GDP, which is where everyone's focused on. Certainly if you are in NVIDIA, if you're trying to figure out how you're going to make all these chips, you're excited. I really wonder if this is the, U.S. manufacturing renaissance. Again, kind of that tall glass of water in a desert. It's easy when you've got a product that everyone wants that people couldn't really have access to because of restrictions that were put in place. Is this going to expand into other parts of the U.S. economy, which is really where all of this trade discussion had wanted to go? Bring back manufacturing, make U.S. more of a significant exporter. We were already exporting as many NVIDIA chips as we possibly could. They couldn't keep up with things. Is there other parts of this discussion which can actually benefit beyond just what winds up being the Mag 7, once again, from a discussion perspective?
All right, Marvin, you're going to stay with us. Really interesting discussion there. I first want to get a quick look on the stocks that are moving in the pre-market this morning. And as we've been discussing, NVIDIA and AMD are moving higher on the back of the AI deal. We're also looking at United Health. That is bouncing back after closing 18% in the last session after it announced that it would be replacing its CEO and cutting and completely removing, I should say, its outlook for the full year. Coming up, we're going to get you set up for your trading day and what to watch. That's coming up next on your Bloomberg Brief.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
This is Bloomberg Brief. I'm Danny Berger, and still along with me is State Street's Marvin Lowe in New York. All right, let's get you set up for your trading day today. We're going to hear from Fed Vice Chair Phil Jefferson. He'll be delivering remarks at 9 a.m. Eastern. And RFK Jr. testifies before the Senate on President Trump's budget request for the Department of Health and Human Services. That's at 1 p.m. And then we'll get more Fed speak. San Francisco Fed President Mary Daly at 5:30 p.m. Marvin, that's certainly a lot of Fed speak. We had Goolsbee yesterday. Any reason to believe that they're not just going to say, we can be patient?
Unfortunately, no. Unfortunately, no. They just don't know. We heard it over the last couple of meetings. We certainly heard Chair Powell during the last presser really say that there's nothing I can do in as many ways as possible. So yeah, they're waiting for the data. Certainly the relief on the tariff discussion gives them a little bit more comfort in terms of the downside. But really, with the market expecting and really wanting rate cuts, nothing that's evolved makes that easier for them.
Yeah, I think it was 22 times that Powell in the last presser said some version of wait and see.
Exactly.
So a lot of uncertainty there. But they're waiting for the data, Marvin. Yeah. Not even just them, but how do you handle the incoming data? It's going to be really distorted as we have shippers rushing to get goods into the U.S. before this 90-day pause is out, as we still have companies sitting on their hands unsure of what to do, and as we likely have consumers also trying to get ahead of any potential price increases.
Yeah. Investing is a real interesting process because there's a lot of different ways of going about it. You could trade it, and that's a lot of times what we talk about, particularly these big moves. If you time the trade right, if you get the call, if you get that call correctly, you can certainly get ahead of it. But then there's a more intermediate, longer term perspective, which is where the asset allocation discussion goes. Like, where do I want to own what type of companies, where in the world? This is kind of a really good time to take a step back, particularly given the rally that we've had, and really look at your portfolio and think about where you want to be, and kind of have those broad markers around what you're looking in the data to kind of get you to your thesis. So, for the most part, traders are going to trade, but analysts that are looking at that intermediate term, they're really wondering how much can the consumer spend? What's GDP going to be? And what's the inflation and kind of interest rate environment around it? And I think that this is a time for us to really assess everything and understand what that data is saying those answers might be.
Well, here's one trade that's certainly going on this morning, and that is a weaker dollar. Let's just look at some of those crosses this morning, because you are looking at the Bloomberg Dollar Index down by about 0.5%. Marvin and I had been talking about this, unable to make new gains with the dollar. Literally 30 seconds, Marvin, but Korea and the U.S. talking on FX. Is this the next target for the administration, a weaker dollar?
You know what? Certainly it does seem to be the focus on many of these conversations, whether we were talking about Taiwan, whether we're talking about, South Korea now. And it is one of the goals of the administration to somehow prop up manufacturing through that weaker currency.
Marvin, it has been such a pleasure to have you join for this half hour. Marvin Lowe there of State Street. And that is it for your Bloomberg Brief Surveillance. We'll take the reins from here. You're watching Bloomberg.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico this way or that way. It will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
There is a lot of appeal to U.S.-denominated assets still.
I don't think we're going to see this resurgence to buy America.
It's very hard to undo a decade of policy that's been very favorable for the U.S.
From a market perspective, anything that lowers that amount of uncertainty is positive.
Most of the gains are behind us because it still is very hard for the S&P to reach new highs.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
How is it only Wednesday? Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Wednesday as the president doubles down on deals.
And with this trip, we're adding over $1 trillion more in terms of investment into our country and buying our products. There are multi-billion-dollar commercial deals with Amazon, Oracle, AMD. They're all here. Uber, Qualcomm, Johnson & Johnson, and many, many more.
President Trump clearing the way for NVIDIA and AMD to sell chips to Saudi Arabia, boosting chip stocks and helping to wipe out all of the equity market losses for 2025. Attention now shifting to Washington as House Republicans push to reach a tax compromise, potentially as soon as today.
Before we get to taxes, before we shift our focus yet again, I think it's fair to recognize just how rare it is to see this type of upswing in this type of period of time, let alone the period of time. It is incredibly rare for the S&P 500 to be down more than 15% and then actually climb out of that hole. It's only been done 5 times over the past span of modern history. So do people have confidence in this, or is this a head fake that is designed to really be a short squeeze and exercise the maximum amount of pain?
I think you're bullied into this if you're missing out on these gains. Over the past few weeks, we've had a positive growth shock off the back of the headlines of the past few weekends. A positive growth shock that's led to revisions in equity market price targets higher, revisions to Federal Reserve forecasts for rate cuts, pushed them out. A positive growth shock that's moved this market in a major way in the last month or so.
A positive growth shock that we didn't necessarily get the worst case scenario. And so suddenly we have long-term investors who are grappling with, okay, is this a really good thing? Or are we looking at tariffs that are still, even after the revisions, at around 16%, which is according to Yale Budget Lab, which is the highest level still going back to 1937. How do you factor that into an economy that we will not get a clear picture of potentially for as long as a year, as we were hearing about yesterday? It becomes really cloudy, and then you add to that the confusion around policy. How much can we just focus now on the tax bill and ignore all that noise?
Well, let's sit on the tax bill and let's talk about the yield curve. So the 2 years anchored around 4%. This idea that the Federal Reserve is anchored around doing nothing for the foreseeable future. Further out along the curve is starting to get really interesting again. The 30-year pushing towards 5% once more, and this time for different reasons.
If you end up with the tax bill as originally drafted, which was a real kind of a rough draft on Friday, and they've been up all night trying to get this together, and then it's going to go to the Senate and it's going to be rewritten completely. So initial estimates do have it increasing the federal deficit by about $5 trillion over the next 10 years. You would have to imagine that this supply would end up pushing yield term premium upward for this long end of the yield curve, which is one reason why people talk about 5-year, people talk about maybe 10-year. Nobody talks about 30-year. Priya Misra talking about that as the risk asset at a time of so much uncertainty.
The bond market in focus, the 30-year this morning, 490, 10s at 445. Coming up this hour, we'll catch up with Victoria Fernandez of Crossmark as stocks erase losses for 2025. Norman Rule of CSIS as President Trump vows to lift sanctions on Syria, and Jens Nordvik of Exante Data on why this is just the start of a bear market rally for the dollar. We begin this hour with our top story. President Trump emphasizing the importance of coalition building in the Middle East. Joining us now from Dubai is Bloomberg's Jordan Fabian. Jordan, welcome to the program, sir. Yesterday, deals, 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 and then a shift to foreign policy. What's the next leg of the trip all about?
Cementing a relationship with another U.S. partner in Qatar. This is a nation that geopolitically they've relied on to try to negotiate hostage deals with Hamas. And the president is also looking to extend that deal making to Qatar as well. There's that possibility that the Qatari royal family gives him a luxury 747 jetliner to use as Air Force One, not to mention other sales from companies like Boeing to the Qataris.
Jordan, how much does this really cement the Middle East's position as a new power broker at a time when power seems to be shifting away from other centers that have traditionally been thought of that? I'm thinking in particular of Europe.
Certainly. I mean, you look at a country like Switzerland that traditionally has served that role as a neutral broker between two nations. And to be fair, we did see that when the U.S. and China reached their tariff détente last weekend. But increasingly, the U.S. and other nations looking to Qatar to broker these deals. Controversially for a lot of U.S. policymakers, Qatar has been a client of Hamas. That's something that some Republicans, even allies of Trump, have scrutinized, say that the U.S. shouldn't have such a close relationship with a country like that. But the president is putting aside concerns about human rights, about traditional U.S. values in the search of a deal. He says, as long as you're dealing with the United States, we're going to look the other way on those other matters.
Hey, Jordan, appreciate the update. As always, Jordan Fabian there. Out of the region this morning on the latest, the next leg of the trip, a turn towards foreign policy after a big boost to chip makers in yesterday's session.
Yeah, who didn't get a boost, right? We were talking about NVIDIA, AMD, Amazon, Alphabet. We're talking even Cisco coming out with some sort of sweetener from that particular transaction, some seeming more concrete than others, but really a deal-palooza over there in the Middle East.
Helped to wipe out what remained of the losses of 2025. Equity futures this morning just a little softer. NASDAQ futures down by not even 0.1%. Here's the view on Wall Street this morning. Victoria Fernandez of Crossmark writing, uncertainty is still the name of the game, but perhaps trade negotiations can begin to offer an off-ramp, with headlines providing some tailwinds to the equity markets and a steepening of the yield curve. Victoria joins us now for more. Victoria, good morning. It's good to see you.
Thanks for having me.
We're back to where we started, 2025. How much has changed, though? How different is this equity market?
Yeah, it's all about the underlying, the internal momentum that we're seeing in this market. So we had the external momentum. We've seen the S&P come and make a 20-day high. We've seen it recover, as you were talking about, in a very quick pace from the downside that there was. But what does that internal momentum look like? And it's still weak. And to me, that's the key component. We just saw this week the amount of S&P constituents making 20-day highs that are in uptrends, sectors that have been in downtrends and relative lows that are now changing to relative highs. The question is it a head fake that you mentioned a moment ago? Are we just on a 90-day pause where is the downside, the declines on the downside, is that reversing a little bit? Yes, but do we have that solid trend on the upside that we really want to see? I'm not sure we're there yet.
Well, let's talk about leadership. Where's it coming from at the moment? And how's that developed over the past few weeks?
So that's changed. And a change in leadership is one of the things that we've been wanting to see to say that this market could continue, right? So we were looking at utilities. We were looking at staples. We were looking at financials essentials before. Now we've started to see industrials come up a little bit. Consumer discretionary is coming up. Leave out Google, leave out Meta, even though that's about 2/3 of that sector. You look at more of the entertainment component, the gaming names, that's starting to take some leadership. So you're seeing that shift, which is positive. But again, is it just because of a headline that we had over the past week, or is it going to be more fundamental?
Yesterday, John asked someone, what's on your dashboard of economic data to watch, given the fact that everyone is saying the soft data is unreliable and the hard data is also unreliable because it's backward-looking, forward-looking, and whichever way you're looking that you would like. So how do you assess the real-time implication for the economy at a time when policy is not set? And you have a motley kind of response from corporate America, with American Eagle withdrawing its outlook, others actually upgrading what they see ahead.
Yeah, I think the soft data, hard data conversation is actually really important. Soft data really kind of telling you where the momentum is in the market, but the hard data being the confirmation of what you're seeing. And typically it's soft data that flows through to hard data. I don't think you can ignore soft data. It is out there. A lot of it is self-fulfilling. When you have consumer sentiment really low, that means the consumer is not going out and buying because they're concerned. So maybe you're not seeing it in retail sales yet, or maybe some of the hard data is really being affected by the pull forward that we saw in front of the tariffs. And so therefore it's muddled, it's a little murky, and I'm not sure we can rely on it wholeheartedly. Even the CPI report we got, you know, people are saying, look at the last half of April where it all started moving up again. Maybe that tells us the next couple months could be a surprise.
I have to say, when we start talking about economic data at this point, my mind starts to hurt because I think about all the variables, and you could talk about even the sentiment data, the soft data, as being backward-looking because, you know, sentiment could have shifted quite considerably in the past
from
couple of moments, from day to day, right? So here's this question. If you still do have tariffs at the highest level going back to 1937, sure, it's not necessarily as high as it could have been. Do we have a sense of what the ramifications are and how much has already been priced in and how much more has to go?
Yeah, I think when we talk about what's priced in, it's interesting because I think a much brighter outlook on tariffs is being completely priced in this week, and maybe that's too much. Maybe we're getting over our skis a little bit in that direction. We've heard that the market could probably take a 10% universal tariff. We heard that in the beginning. There'd be a little bit of noise, but it would be something we could handle over the long term, and I think it's interesting that that's kind of where this administration has come back to. If you look at the deal with the UK, if you look where we are with China, it says 30%, but 20% of that is actually a fentanyl component. It's the 10% that's on the tariff. So maybe that's where this administration comes back to and says, we can handle that, and over a 10-year period, talking about the budget, that's about $2.25 trillion. So I think there's some math going on behind the scenes as to where these numbers end up.
Speaking of the economic data, the number 5 container carrier, Hapag-Lloyd, had this to say, estimating the boost of more than 50% to volume compared with recent weeks. The last couple of days, we've seen a huge surge of volume, and now we need to see how long that lasts. So we've had the front loading, then we had some quiet, and now we've had a boom again.
Yeah, and we heard the same kind of tone from Maersk, right? The idea that these ships are gonna start going in mass because everyone's gonna try to pull things in as quickly as they possibly can. Ryan Peterson of Flexport saying there is going to be a boom in deals. So how do you price that in?
There's a scramble. The Fed chair's head must be spinning. Yes. The president's pushing for rate cuts. The inflation data was a little bit better than expected yesterday. How much comfort can you take from that?
I don't think there's much comfort there, actually. And I think when we see the premiums go higher on the longer end of the curve, as you were talking about a moment ago, some of that is because we're just pushing cuts further out in the year, in my opinion. If I'm Powell and I'm sitting there, and he doesn't ask my opinion, but if he did, I mean, I think he's saying, look, now I've got even more uncertainty I have to deal with. Now he just pushed my decision time 90 days out with the deal he made with China. I thought I was going to be okay July, maybe making a decision. Now I'm in August. I'm at the September meeting having to do that. So I think his job just got a little bit harder, actually.
We're looking forward to the update to the forecast in the next month or so. Victoria Fernandez across market is going to stick with us. If you're just joining us, equity futures this morning negative by about 1/10% on the S&P 500. Lots to talk about regarding the tax bill. We'll do that in just a moment with an update on stories elsewhere this morning. With your Bloomberg Brief, here's Yahara Ahmed. Hey, Yahara.
Hi, John. On that tax bill, House Speaker Mike Johnson says a compromise on SALT could come as early as today. A proposal being debated would increase the cap from $10,000 to $30,000, phasing out for individuals who earn at least $200,000. The standoff over SALT is one of the remaining sticking points as Republicans seek to advance President Trump's tax cut bill through the House. Meanwhile, NATO allies are working on an agreement to significantly boost defense spending. Negotiators are making progress on a path to achieve 5% of GDP on defense and related spending by 2032. The agreement would mark the biggest spending increase by Western allies since the end of the Cold War. And President Trump continuing his criticism of Fed Chair Jay Powell, posting on Truth Social after yesterday's CPI data saying no inflation and prices of gasoline, energy, groceries, and practically everything else are down. The Fed must lower the rate like Europe and China have done. What is wrong with too late Powell? That's your Bloomberg Brief. John?
Yahara, thank you. The pressure is never ending. Up next on the program, closing in on a compromise.
This bill will get to the president's desk, and we hope to do that at least by July 4th, if not sooner. We believe this is going to be jet fuel for the economy. It will also send a very important signal of stability to the bond markets and the stock market.
We'll get to that in just a moment. We'll catch up with Bloomberg's Tyler Kendall live from New York City this morning. Good morning.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
This equity market wiping out the losses for 2025. Positive for the year. Positive post-April 2nd. Up from the low by almost 20% on the S&P 500 in just a number of weeks. This morning, negative by 0.1% on the S&P. Likewise on the NASDAQ. Under surveillance this morning, closing in on a compromise.
This bill will get to the president's desk, and we hope to do that at least by July 4th, if not sooner. I think in this bill, what we'll do to extend the Trump-era tax cuts is going to be critical for the economy. We believe this is going to be jet fuel for the economy. It will also send a very important signal of stability to the bond markets and the stock market to let people know that Congress is on the job.
Here's the latest this morning. House Speaker Mike Johnson saying Republicans could reach a compromise on the SALT deduction today, a main sticking point in Trump's economic package. Bloomberg's Tyler Kendall joins us now from the nation's capital for more. Tyler, let's talk about that sticking point. What does a compromise look like?
Yeah, hey, John. So at this point, the proposal that's on the table is what you outlined there. It would lift the SALT cap from $10,000 to $30,000 per individual and be phased out with income limits. But these Republicans from high-tax states like New York, New Jersey, California say that's not enough to ease the tax burden on their constituents. And for context, they came into this week saying that they wanted to see that cap lifted to $62,000. Now, we know House Speaker Mike Johnson is negotiating with them directly, and there appears to be a way out of this, which is is that the tax bill currently on the table is pricing out at about $3.8 trillion. We know the House had about $4 trillion to work with, so there could be some additional room there. But of course, that would spur concerns by fiscal hawks who are looking for savings where they could. A few different areas where we could potentially see some compromise. The Speaker said that they're considering doubling the cap for married couples. That could potentially be somewhere where we could see some broad consensus. And then the other thing to watch for could be expiration date. So perhaps they will lift the cap to a higher level, but it just won't stay in for as long. John, in all of these conversations, though, important to keep in mind that these lawmakers are really digging in. These are Republicans that represent swing districts in blue states. They say that they help deliver this majority for Republicans, and this is the issue that they campaigned on.
And Tyler, nobody is sleeping in that city right now. It sounds like everybody was up all night trying to go through this draft, which sounds like a lot of fun. Now, of course, it's going to go over to the Senate if it does pass and get completely rewritten. So do we have a sense of how much House Republicans and Senate Republicans are on the same page?
Yeah, Lisa. In fact, they actually are still on the Capitol, still working through this markup. One estimate that we got is that particularly when it comes to the tax cuts, that could go into mid-afternoon. It's going to be 24 hours plus of debate. Now, both sides say that they are working together. If you listen to President Trump, he says that the White House is closely in touch with both leaders, House Speaker Mike Johnson and, of course, Senate Majority Leader John Thune. But at the end of the day, it depends on who you ask, because Senate Republicans have already signaled concerns with a few things that the House is doing, including the SALT cap, but also when it comes to those Medicaid cuts that we are expecting. The current House proposal does implement those work requirements for able-bodied adults ages 19 to 64. We know that's going to be a sticking point in the Senate, but at the same time, there's also a lot of fiscal hawks in the Senate who want to see some deeper spending cuts, so we're going to have to see how this all shakes out.
Critical for the economy, jet fuel for the economy. Tyler Kendall, thank you. With us to extend that conversation, Victoria Fernandez across Mark. Victoria, your view, is it both critical for the economy and jet fuel for the economy?
It is critical, I believe, for the economy. When you look at all of the elements that this administration wanted to bring together, they hit us with tariffs first, which was kind of that negative component on the economy. They need the tax component, they need the deregulation component to come in and help buffer that. Is it jet fuel? I think it's more of the buffering than the jet fuel in order to kind of bring this economy back onto solid footing, like we were talking about earlier, get those internal fundamentals going. But it really frustrates me when I hear them say they're digging their heels in on things. And because a good deal, they always say, is one where nobody's really happy. And so that's what I think we have to do here. They have to have some compromises on something, whether it's SALT, whether it's on the Social Security components, whatever it may be, the healthcare components. There has to be some kind of a compromise, and until we see that, I'm not sure we're going to get much out of it.
Well, let's focus on the composition of the agreement, if we do get one. So there is a difference, of course, between removing a potential headwind and providing a tailwind. The bulk of this bill is going to be extending current law.
Right.
What are the sweeteners that could act as that jet fuel in the years to come?
Yeah, I think some of it are the campaign promises that people are looking for to see. So the no tax on tips, right? Lowering taxes on seniors, some of that. The SALT deductions. And they're actually talking about closing loopholes, right, on pass-throughs for SALT, which they're saying is going to raise like $900 billion. Okay, well, that's great if we can see. Everyone loves a closed loophole. So if we can get some of those things done, maybe that's positive. But that's where we have to see some of these elements come in. We're seeing child tax credits getting extended, incentives for businesses in regards to building, manufacturing plants and R&D and expensing all of that. That, I think, is where you're going to get the tailwinds coming. We'll see profits increase in corporations. To me, that's saying margins are better, employment will stay well, and consumers will spend.
Maybe I'm just naturally a nervous person, but as we start talking about this, there are sort of two sides of the coin that both potentially could be really problematic for the bond market. Either you've got jet fuel that injects some sort of growth shock that is positive, but also potentially inflationary, or on the flip side, you have essentially a less growth forward type of proposal that increases the deficit and also creates a problem for long-term bonds. So do you see it either way potentially being a risk for the bond market.
Yeah, either way, you're going to get a steepening, I think, of the bond curve, right? You're going to see that longer end go higher, in my opinion. And we talked about Powell a little bit earlier. I don't think that puts him in a great position to say, well, great, let's cut and bring the shorter end lower. So I think you're going to continue to see yields move up on the higher end. I think they'll probably stay somewhere around the 450, 460 level for now, being in kind of that trading range. But that pressure is there. It's really, Lisa, you know, it's the credit component, right? Credit component, you look at investment grade credit, it's only out about 20 basis points on the year. High yield, obviously much further, about 250, 300 basis points out on the year. So I think they have to watch and see what happens to the credit spreads. And does that give them a signal that maybe things have gone a little bit too far?
This is important. You think that the credit side of things is the more interesting one, not the duration side that could potentially speak to the whole bond vigilante movement that could get spurred by some sort of deficit spending plan.
Well, because it's that credit component that I think is really kind of the underlying driver of what we're seeing across the board. It's what's going to tell us what can happen with earnings. Earnings is going to drive, like I said, what you see with profit margins and with employment and all of those elements that the Fed is watching and that the market responds to. So I do think we have to watch credit, although I will say over the last few months, the FX markets have been driving more than the credit markets, which isn't typically what we see, right? Credits usually are canary in the coal mine, but it's that combination, I think, of concern around credit and what's going to happen if corporations don't get the incentives that I think they're waiting on, which means we're not going to see CapEx intentions probably go higher. There's going to be some concerns there, but then you also look, we had a very poor 30-year auction. We saw yields go higher after that. What does the demand look like there? It's very much a combination of the two.
What do you think is behind those poor auctions? Because I think there's a big difference between saying we're going to have deregulation, pro-growth, pro-risk bills going through Washington, and that leads to high yields. A difference between that and people starting to worry about financing the deficit, international investors requiring a weaker dollar and higher bond yields. Which road are we going down?
Yeah, I think international investors are still there. Maybe they're not buying quite as much, but we're not seeing them really go in and sell out of their treasuries. There was this huge concern around that. We're seeing it more on the equity side. We saw in the last week of April about 15 billion move out of U.S. equities and in to European equities. So we're seeing that transition there. I don't think that's it. I think it's more of a concern around the debt. I think you could have some bond vigilantes out there. And it could be people saying, wait a minute, if this is all going to happen and yields go higher because recession is now less of a concern, maybe I'll wait on the 30-year until yields are a little higher and lock that in.
So put that all together. What are you doing with bonds?
So we've actually done, and I know you hate this word, but we're doing a barbell in our strategies, and so I should whisper that over here to Lisa.
I could tell where you were going with that, the hand motions.
But I think it makes a lot of sense. That kind of belly of the curve has been the most expensive part of the curve. So you've got to do what's best for your clients, and that's buying on the short end, and then it's going out a little bit longer and locking in there. We're not going out 30 years, but we're going 7 to 10, and then buying some on the short end too. I think when we finally get easing later this year, that'll be beneficial, and we want to have cash flow for clients.
There's two words we despise even more, idiosyncratic and diversification.
Good, I didn't use either of those today.
You want to be diversified.
Yeah, diversified, idiosyncratic. I think transitory can get thrown in there too.
Yeah, transitory belongs there too.
Short-lived, as you pointed out.
I think the list is long, right? Victoria, it's good to see you. Thanks, you for being here.
Appreciate
Thank you.
it.
Victoria Fernandez there of Crossmark. Up next on the program, we'll catch up with Norman Rawl of CSIS as President Trump vows to lift sanctions on Syria. Live from New York City this morning. Good morning to you all. Equity futures on the S&P 500 just about unchanged. From New York, this is Bloomberg.
Today, CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episodes this spring, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Wall Street absolutely scrambling to update forecasts. Big revisions following the US-China trade truce over the weekend. Upgrades to the S&P 500 from Goldman, from Denny. Wells Fargo and Chris Harvey saying this: stocks have come very far, very fast. We think that what were ceilings now become floors and expect dips to be bought. Saw some evidence of that already this morning. We were down a few tenths of 1%, and now we're almost positive. On the S&P, we flip into the green on the Nasdaq 100 in the last couple of moments. 3 hours away from the opening bell. Let's get you some morning movers. We can do that this morning with Danny Berger. Hey, Danny.
Hey, John. One stock that's still decisively into the green is NVIDIA. Shares up 1.8%, still enjoying that afterglow of the benefit of all the deals announced at the U.S.-Saudi conference, giving Saudi more chips as the Saudi new venture looks to build out a data center, as the U.S. also considers letting the UAE have more chips from NVIDIA too. Dan Ives writing a note this morning saying that it is an AI revolution for Saudi, a new market for NVIDIA, especially as China continues to face restrictions. Also, one of the biggest movers for the S&P 500 pre-market is United Health. Those shares up 2.6%, but it is a bounce back from a big decline yesterday, 17% after the company completely suspended its outlook, named a new CEO. We're getting more details about that new CEO this morning, about some of the compensation that he will get, a $1 million base pay, $60 million in equity options. They were also sure to underscore that he would have security benefits as the new CEO. Finally, rounding things off this morning with a company that has also suspended its guidance for 2025. That is the retailer American Eagle. They blamed macro uncertainty, but to be clear, the first quarter, they gave a pre-update of that, looking very weak for them too. It had excess inventory, they had discounts, and again, they just had an inventory write-down too. So those shares massively under pressure this morning, down 14%, John.
Danny, thank you. I can't think of a more difficult time to try and manage your inventory through all of this over the last few months. The pandemic was the pandemic, whatever that was. This moment's been tremendously difficult for these guys.
They have to deal with not only the potential of tariffs, but also fast-moving fashion, particularly for the teenage set, which I can tell you is a very fickle bunch. But I will tell you that I do find it interesting. Some pulling their guidance, some upgrading their forecasts, like on holding. How much is execution and how much really is the macro environment?
Another update coming tomorrow, retail sales tomorrow morning and earnings from Walmart, so look out for all of that. On our radar this morning, President Trump delivering on his promise to strike deals on his Middle East trip, clearing the way for NVIDIA and AMD to sell chips to Saudi Arabia. Both of those names, Bramo, again this morning, higher in the pre-market.
Fascinating to me, the fact that, first of all, to set the stage for this trip, President Trump got rid of the so-called diffusion rule under Joe Biden, which was basically to prevent or limit the number of chips that could be sold to places like Saudi Arabia and Qatar. Now they're talking about selling a massive amount in addition to getting these contracts for the likes of NVIDIA, AMD, Global AI, Amazon, Cisco, Alphabet, OpenAI, the list goes on and on and on. Question now goes to, are there any strings attached? Is there going to be any kind of way to avoid having those sales go over to China? What are some of the details underpinning some of this, given some of the strategic discussions that have been going on in the United States with other trade negotiations as well?
What's clear, though, the president's in deal-making mode big time internationally over the past week or so, both on the chips front in the Middle East and the trade front in Geneva, with the Swiss brokering that deal between the Chinese and the United States. Scott Bessent getting that done. And that's seen this equity market unwind all of those losses we've seen over the past few weeks. Now attention turns back to Washington. And we're going to hear a lot about the tax bill in the weeks to come. The House Speaker, Mike Johnson, saying Republicans could reach a compromise on the SALT deduction as early as today, a breakthrough in one of the biggest sticking points in advancing President Trump's tax agenda. And then it's on to the Senate. And as you said, then it's back and forth, back and forth, back and forth, and this could be taking a while. But ultimately, they've got an aggressive timeline. They want this done by Independence Day.
And they're basically not sleeping in order to do it. The fact that they've basically been up all night in order to write and rewrite some of the details here is important. Tyler Kendall pointed to the fact that some proponents of increasing the SALT tax deduction have talked about how some of the proposals are not as expensive as people previously thought, so they can use that extra wiggle room to potentially go toward increasing the SALT tax cap. And so here's the question: who's going to win out? The sweetener crowd or the fiscal hawks? Because that really is the battle that the market is going to be watching most closely.
Or the bond market.
Exactly.
And we've been talking about that a few times. I think you've got to pay attention to the long end of the curve. It's subtle, but we're just starting to push those levels, push back to those levels that got people nervous a month ago.
And it goes to this theory that we've talked about extensively, where if you don't necessarily have tremendous amount of growth, but also a marginal increase in the deficit, that could be the wrong kind of sell-off, the long end of the yield curve that I think a lot of people are trying to avoid.
The president celebrated defense spending just yesterday. NATO allies are working on an agreement to boost defense spending themselves in order to meet President Trump's call that they allocate 5% of GDP. Sources telling us here at Bloomberg that NATO foreign ministers will discuss the initiative this week.
And this really would boost spending for the entire region for the first time, or to the greatest levels that you've seen since the Cold War. I mean, if they were to actually go through with this, they are in discussions. Mark Ruda, who has been actually a proponent of some of these, has been instrumental in this. I am just curious how far they will go and whether this is viewed as stimulative. I know that a lot of people have been talking about this is one bullish case for Europe because they're going to be spending. Is it for a growth perspective, or is it for just some of the defense companies that have seen the biggest boost from this?
Can we just think about, though, and reflect on the difference between now and the president's first term? The sneering, the smirking, the pushback that he received when he was pushing them to spend more. And here we are, years later, and they're all getting together without him, trying to push defense spending up to 5%, not because they're trying to bow down to the president, but because they realize he was right all along. That's a major change.
There has been a major shift, and there are these arguments, and they have some real credence that some of what President Trump is doing is pushing other regions, including Europe, to do what their economies need anyway. In this case, the backdrop of the Ukraine-Russia war really drives home the need for them to beef up some of their military resources at the same time that the U.S. is threatening more strings attached. So it's a very different reality, but you are right. This is a very different tone in these negotiations.
Huge wake-up call for the Europeans over the last several years, that's for sure. Let's stick with foreign policy. President Trump vowing to lift sanctions on Syria and ramping up pressure on Iran to strike a nuclear deal.
We are currently exploring normalizing relations with Syria's new government, as you know. I am also ordering the cessation of sanctions against Syria to give them a fresh start. I want to make a deal with Iran, but for that to happen, they cannot have a nuclear weapon.
The former senior U.S. intelligence official Norman Rule writing the following: the president's visit reinforces the growing sense that Saudi Arabia and the UAE play an expanding role on the world stage. Norm joins us now for more. Norm, welcome to the program, sir. I just want to pick up on that line of thinking. If that's the case, if they spend an expanding role on the global stage, Norman, at whose expense? Who is being left out?
Good morning. Well, I think their view would be no one is being left out, but rather they are playing a new role where they connect the global north, the global south, and they're able to represent voices that previously weren't heard so often. Africa, India, and the smaller countries of the world. The COP28 that took place in Abu Dhabi, I think, was a representative of this and changed many regional views. And they see that they can bring together Zelensky, Putin, President Xi, President Trump, and they can solve problems in a way that Europe is no longer able to do so.
So, Norm, let's talk about one of the problems that they tried to address yesterday, and that was Syria. What's the significance of lifting sanctions on Syria?
The significance is huge. It provides Syria with economic possibilities to restore an economy that's been shattered by years of sanctions and its own mismanagement. This decision also comes at a time when Europe is considering its own sanctions posture towards Syria. For Syria to reestablish itself in the international community, particularly in the Arab world, independent of Iran's control, it must have a viable economy. There were great celebrations throughout Syria after the president's announcement, with the credit going to the Saudi Crown Prince for making this request.
There's a good deal of skepticism, Norm, about this embrace of the Middle East, and a question of how much they can fill that role that Europe used to play of being a true ally of the United States, and whether they can be relied upon over a longer period of time. From an intelligence perspective, do you think that there is some dissonance there, or do you think that the rules of the game have just completely changed in terms of who the allies are and who are not?
I think it depends on what game you're playing. I think it depends on what your targets and issues happen to be. If you care about freedom of navigation and you're looking at the Red Sea, if you're looking at the Persian Gulf or other locations, you're going to have to work with the local players, and you need to give them a capability to burden share. So the president's significant military package to the Saudis actually enhances their capability to do what we would need them to do to burden share in that area. And in many ways, this is what we did with Europe over the decades.
There is this question, Norm, about whether this is going to become a liability down the road. And there is also some concern about opening up. Yes, it's a deal palooza, and yes, you see all the tech leaders in the Middle East trying to get deals. But the prior administration was trying to limit some of the chip sales to the region. They were concerned about potentially those chips getting passed along to China and beyond. And this question of what kind of limits are we setting on these strategic areas? Do you have a sense of what kind of strings are attached around these chip sales?
Absolutely. And it's an important and valid concern that the previous and current administration share. And the Saudi and Emirati position have been clear. Tell us exactly what you want us to do to make sure this technology is protected. They have not said, this is what we'll do and you have to live with it. Rather, they have said, tell us what we need to do in terms of a security architecture, physically, in terms of access, in terms of how we use this data, this material, to make sure that it does not touch your security equities. And that explanation satisfied sufficient critics within the Trump administration to make this proposal possible. And it will be transformational, not only for Saudi Arabia and the Emirates, but there will be a splashover into the region. You're going to see their engagement with India, Africa, and Europe change dramatically as a result of this.
Norm, do you think that some of the naysayers of all of this are just worrywarts? The people who are talking about the plane from Qatar to the president as being a security hazard, or other types of complaints, are just people who are trying to find something to gripe about? Or do you think there's anything legitimate here?
Well, the world is filled with people who like to gripe, and there are plenty of legitimate criticisms in the world. I'll leave it to others to talk about whether or not this plane is a legitimate gift or not. But in terms of what we would do in a security sense, we have more than sufficient technical capability to ensure that if a plane like that were to come to the United States, that we would be able to make sure that it is not a security threat to the United States. It would be stripped and rebuilt in many ways to have equipment placed in it so that it could be used. So it's not going to be a security threat once it's looked at. But as to the appropriateness of its acquisition, that's for others to talk about.
Norm, since we're dealing with worries, can we just finish where we started and address one significant worry? Who is this individual running Syria right now? We understand his role in overthrowing Assad, and we understand that Assad was backed by the Russians and the Iranians to some extent as well. But is being the enemy of my enemy's friend sufficient to make you a trustworthy partner in the region?
Individuals who have dealt closely with the president of Syria state that he seems sincere in his desire to be a president of Syria, that he is driven not by his previous associations with al-Nusra, an affiliate of al-Qaeda, but rather of a desire for a unified Syria. His approach to handling the Kurdish issue and some of the other ethnic elements of Syria is reassuring, but the proof is going to be in the behavior going forward. And the fact that the president is talking about lifting sanctions doesn't mean sanctions can't be placed in the future if that behavior is reversed.
Without a doubt, one to watch. Norman, thank you, sir, for your thoughtful responses as always. Norman Rule there of CSIS. Things are so busy on the foreign policy front, we didn't even get to Ukraine. And the potential for a significant meeting taking place in Turkey tomorrow.
Yeah, this might be the first meeting since the real conflict began in Turkey between Zelensky and Vladimir Putin. I know that Zelensky has talked about President Trump possibly stopping by to say hello and popping in. You raise a good question, though, about the Syrian president and this question of, do you give a chance? Do you not? What do we know? At the same time, how do you support an economy that's been flat on its back at a time where potentially it's getting a new start?
Things are delicate there. They always are. Equity futures this morning just about unchanged on the S&P with an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara. Hey, Yahara.
Hi, John. Israeli Prime Minister Benjamin Netanyahu says he's days away from ordering an all-out escalation of Israel's war against Hamas. Netanyahu says his armed forces are preparing to, quote, finish the job. Hamas this week released the last surviving U.S.-Israeli hostage, but still holds 58 Israelis, with fewer than half believed to be alive. Meanwhile, Burberry shares are rising nearly 16% in London trading, the company announcing plans to cut as many as 1,700 jobs, representing about 18% of its global workforce. The cuts will amount to an additional savings of $80 million in the next 2 years. The announcement also comes as the company reported better than expected comparable retail sales in the fourth quarter. And hundreds of Starbucks workers have walked off the job to protest a new dress code which requires baristas to wear solid black tops. Starbucks Workers United represents staff at about 570 of the 10,000 company-run U.S. stores. It's filed a complaint saying dress code changes during contract talks are unlawful. That's your Bloomberg Brief. John?
Yahara, thank you. Gonna leave that there.
Really?
Yeah,
wow, I'm impressed. That's seriously restraining.
Been very, very disciplined this morning. Up next, a turning point for the US dollar.
Fiscal deficit's still being high, likely the trade deficit's being high. That on balance, I think, means the dollar is likely to be on something of a weakening trend.
Jens Nordvik of Exante Data joins us next. Looking forward to this one from New York City this morning. Good morning to you all. You're watching Bloomberg TV.
Incidence of cancer, which is to say people getting it, is higher than it was 20 or 30 or 40 years ago. Is that because detection is better than it used to be?
All right, so the dirty secret is we have no idea. We don't collect data well in the United States. What we do know is that there's not a dramatic rise in cancer in the United States, but what we are seeing is a troubling trend is younger people are getting more cancers. That's real. We have no idea why, but we are seeing younger people, more colon cancer, more breast cancer, and other cancers in younger individuals, 20, 30, 40-year-olds, that we never used to see.
What do you think could possibly be the cause? I assume pollution or the environment in some ways?
We assume it's either something in the environment, we assume it's diet, it's ultra-processed foods, it's microplastics, it's changes in the microbiome. We really don't know.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, We'll show you how.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Equity futures this morning, just about unchanged, stable at the moment on the S&P 500. A raise in losses from early this morning. We were down about 0.1% or 2%. We're now unchanged on both the S&P and on the Nasdaq 100. We're positive by almost 0.1%. Under surveillance this morning, a turning point for the US dollar.
The reality is, the dollar is at the center of the global financial system. That is an extremely sticky phenomenon that's been a part of our backdrop for decades. You see the likelihood of ongoing twin deficits, those fiscal deficits still being high, likely the trade deficits being high. That on balance, I think, means the dollar is likely to be on something of a weakening trend.
So here's the latest this morning. The dollar sliding as traders weigh a potential new focus for the White House. A person familiar with the matter telling Bloomberg the US and South Korea discussed currency policies earlier this month and agreed to continue talks. Jens Nordvik of Exante Data has been bearish on the dollar for months and writes the following. It's likely that we're at a multi-year turning point. I think the dollar should be moving substantially. Jens joins us now for more. Jens, good to see you, sir.
Good morning.
It's been too long. Thanks for dropping by. We've got some time to work through this. You're looking at potentially a system-level shock that leads to a strategic reallocation of the US dollar away from the US dollar to other currencies. Can you just set the scene for us from 35,000 feet, what you think's happening here?
We've really been on a strong dollar trend since the summer of 2014, right? So we've had this incredible run in US equities. We've had US yields that were generally higher than other places around the world, and investors from Europe to Canada, Australia, Japan have been very comfortable building up really big allocations to the US, unprecedented high allocations, right? And now we're coming into this year, a lot of people were expecting, oh, okay, Trump 2 is going to smell a bit like Trump 1. People actually added aggressively to their equity exposure into this year, right? And then it has turned out that Trump 2 was not really anything like Trump 1. And a lot of people are rethinking those allocations. And it's not just about the tariffs, right? It's about what's happening with foreign policy, who are allies, what's the NATO arrangement going to be. There's a whole host of issues, right, that means that a lot of people are thinking about, is it really prudent as somebody who's allocating globally to have such an incredible overweight in the United States? So I'm not talking about is the reserve currency status going to disappear. We're talking about people who have been very, very overweight. Are they going to do some risk management and take the allocation down? And I think the feedback we get from speaking to chief investment officers all around the world is that it takes a lot to shock them, but they are shocked, and they want to change their allocations.
To your point, this has been building for a decade plus of dollar longs building across all asset classes. What we're trying to understand now is, as we take some of the air out of that trade, what are the policies that you see that make the shift away from the US dollar sustainable, durable, beyond just the chaos of the last month or so? How do you think about that at the moment? And do you consider them a push dynamic, bad policies in the US pushing capital out, or a pull dynamic, better policies elsewhere sucking capital in? Which one is it?
Yeah, so the first thing I would say is that we have a list of US policy shocks. And that list of policy shocks is actually generating policy shocks elsewhere, right? So in Europe, we've had now a historical change in fiscal policy where essentially the fiscal rules have been rewritten, right? The rules that underpin the euro have now been changed in a way where you can invest more effectively, right? That's a big change. So that's important for the growth outlook in Europe. We just talked about, as you mentioned, right, the NATO budget potentially also totally different, right? 5% numbers. We used to talk about whether we can get to 2, right? So big changes. So that's something that underpins this idea that there are other places, because if you have more investment in Europe, you also have more bond issuance, right? So the whole supply and demand dynamic is changing. It used to be the case that there was actually very few assets to buy in Europe, and that's changing too. If you look at the comparison between international investors and US investors, in the US, you have an incredible home bias. That's the other part of the story, right? If you look at all ETFs that are issued in fixed income in the US, 1.7 trillion, there's only 0.5% that has any foreign currency exposure. So it can only go one way from here. That's not going to be quick, but over time it will happen.
There's an important point here. You said that this isn't necessarily the loss of the dollar as being a reserve currency. This is just simply a normalization and diversifying away from the dollar. Some people might say that this is a feature, not a bug of this administration, that they want a weaker dollar in order to increase exports. And actually, we're going to see this increasingly as a part of policy, not just as a potential consequence.
Yeah, I think you're right. We certainly have people within the cabinet, Scott Bessent included, right, that have a different nuance to dollar policy compared to the past. There's always this focus on, okay, how do we insource some manufacturing, and a weaker dollar certainly would be helpful in that regard. And you're right. I think if you look at the price action today, it is influenced by these, let's call it Bloomberg headlines about Korea trade deals, so and currency deals. So there's an element of that. So nobody's going to be fighting this trend if the dollar is going gradually weaker.
How much more weakness is there? And potentially, do you see the euro as the biggest winner?
So again, we've literally been going in one direction for 11 years on a trend basis, right? So we've just started, and if we have a big asset allocation shift, it's something that can play out over a 6 to 9 month horizon, and we can easily have, you know, a 5% move down in the dollar index, right? And then we get to these questions, okay, is it going to be orderly, or could there be something that's more dramatic, right? And what we had in April, I have never seen. I've been doing currency analysis since 2000, effectively, right? What we saw in April, we have never seen before, right? Where U.S. bonds are selling off, equity is selling off, and the dollar trades down. So I think that was only for not that many trading sessions, but it's still a warning sign that that can happen, right? So I am, in addition to what we just spoke about, like I think there's some additional tail risk that if the budget process is not one that investors are comfortable with, I worry that we can have some of the same dynamics as we had in April. So that wouldn't be my central case, but the people who are involved in these budget negotiations have to remember what happened in April. The U.S. bond market is not a kind of indisputable safe haven anymore.
Yeah.
And what happens with the budget is absolutely going to matter.
There's evidence that spooked not only investors, but also the White House in the last month as well.
Yeah, you said yesterday, who's the bigger arbiter, Republicans or the bond market? And I think a lot of people are watching the bond market very closely.
Based on this conversation, it might be the bond market. Jens, good to see you, sir. It's been too long. Thanks for dropping by. Jens Nordvik there of Exante Data. Up next on the program, Wei Li of BlackRock, Tobin Marcus of Wolfe Research, Holly O'Neill of Bank of America, and the former New York Fed President, Bill Dudley. From New York, the second hour of Bloomberg Surveillance. Up next.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
We'll have to see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean.
I do factor in some effects of tariffs now on inflation, on prices.
I like the idea of the 10% tariff across the board.
I've spent my entire career focused on fiscal discipline. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government.
Elon Musk is
probably the inventor of our age, but who understands that we're in the midst of the most profound convergence among technologies.
When we are facing a once-in-a-generation technological disruption,
we cannot close this retirement gap without private-public partnership. We have to have good policy.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
I would take the other side of that bet.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday, only on Bloomberg. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
It's really hard to get a true economic read.
It sounds like there's a lot going on under the hood.
Potentially there's more growth worries priced in the U.S. than elsewhere.
The risk of recession is receding here.
If there's still uncertainty on the other side of that bad data, it's very hard to sort of look through that.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The president just touching down in Doha. We'll get you an update from Anne-Marie in just a moment as we commence the second hour of Bloomberg Surveillance. Good morning to you all. Your scores look like this on the S&P 500. Equity futures totally unchanged this morning on the S&P, slightly positive on the NASDAQ. A quiet session today, a busy one tomorrow. Tomorrow, you'll hear from Chairman Powell, you'll see retail sales, and you'll get an update from Walmart as well. Look out for all of that. Our heads are still spinning here at Bloomberg. What a year it's been so far. Year to date on the S&P 500, we are now positive, up on the year. We dropped almost 20% from the highs. We've rallied more than 18% from the lows. This has been vicious. It's been fast.
And it's been rare. This typically does not happen. Just to put this into perspective, I keep going back to this. Bespoke Investment Group came out with the statistics showing only 5 times in modern history have we seen this kind of retracement of a more than 15% loss in 1 year. So it raises this question, is this the start of something bigger, or is this a sort of knee-jerk response to headlines that potentially could change at any moment when we're staring into the black box of data that's messy and a Fed chair who's telling us just wait and see, wait and see, and wait and see?
We've heard all these comparisons to the pandemic. It's not the pandemic. And we've said repeatedly on this program, the biggest difference is the president can turn the virus on and off whenever he likes. And over the weekend, he turned it off again.
There seemed to be a real sea change when it came to the relationship between the U.S. and China. The fact that tariffs were brought down, the pause period, and suddenly there was not a goal of decoupling fully. I think that phrase really changed the game for a lot of people. Suddenly, there were the contours of the rules of a new game, that more broadly, these two economies, the biggest in the world, are interconnected, but in a couple of key areas, there are going to be greater disputes. Of course, the problem with this is the world doesn't stay on hold for 90 days. And we see the Chinese leader, Xi Jinping, heading over to Latin America, trying to strike deals over there, criticizing the UK-US trade relationship. So this story isn't written yet, but but for now, the temperature has been turned way down and people are celebrating.
The mood music has changed, that's for sure, in this market. The focus shifting once again. This time is shifting towards tax policy. We'll get you an update on that as well in the next 20 minutes or so. Equity futures just turning positive on the S&P 500. We're up by 0.1%, turning positive on the year as well. We'll catch up with Waitlist of BlackRock in just a moment. We'll also speak to Holly O'Neill of Bank of America on the state of the U.S. consumer. And we'll get you an update from the former New York Fed President Bill Dudley on why the Fed's problems aren't over. We begin this now with our top story. President Trump in the Middle East, emphasizing the importance of coalition building. Anne-Marie just landing in Doha, head of the president, and she joins us now for more. MH, welcome to the program. Welcome back. Give us an update on what you're expecting today, and please take some time to reflect on what we heard just yesterday.
Well, really yesterday, Jonathan, I think wanted to highlight this administration, the economic relationship, the deals the president was able to put over the finish line. A lot of that we need to make sure we're tracking because it's big numbers. Do they actually come to fruition? That's what we're going to be keeping an eye on. Things like AI, data centers, advanced technology, those chips that Saudi Arabia, UAE now going to be able to get their hands on. Really a transformation of a lot of these economies that have been traditionally economies. They're able to exert their influence due to the price of oil and gas. The president is now really shifting towards foreign policy, and what better place to do that than Doha? Whether or not it's the Trump administration or the Biden administration, Doha and Qatar has served as this mediator when it comes to talks in Gaza, when it came to the fall of Kabul and Afghanistan. The Qataris have seen as a place where they want to step in and try to mediate. So we do have the past few weeks, as soon as yesterday, we had negotiators here from Israel. Of course, this is where Hamas's political office is, as well as American officials are here trying to get some sort of ceasefire agreement when it comes to Gaza. And we should also reflect on what happened this morning. The president this morning met with the new Syrian leader for 33 minutes, and then he came out and talked about the fact that maybe we're going to have new relationships, normalized ties with Syria. This comes after yesterday, the president talked about a cessation of sanctions on Syria, and I'm getting mixed messages from Washington, D.C. There's some people who say, why do you continue to keep a country in chains due to the actions of the previous regimes? And there are others who are skeptic about al-Sharaa and obviously his ties in the past as a militant leader in al-Qaeda. But as Norm Rule said in the last hour, he was talking about the fact that they do think this is someone that the administration sees as he wants to turn over a new leaf. The Arab world erupted in that room yesterday because they want to make sure Syria stays within the Arab world and is not leaning towards Iran.
It's a sea change in the region. Anne-Marie, appreciate the update. Stay close. Anne-Marie's going to go off and do some reporting, and if we get any headlines for you, we'll bring them to you. It's been a big move, both for the broader market and for chip stocks specifically. That deal for AMD, for NVIDIA, looking for new markets when they've been effectively closed off by the Chinese and the US and their fight that continues.
This really is the key point. How much do the sales in the Middle East really offset the lack of sales that you get over to China, given the fact that there will be that strategic decoupling that Treasury Secretary Scott Bessent talked about?
Let's get you the view on Wall Street. This from Waitlist of BlackRock, writing the following. We still see tariffs causing further contractions in quarterly activity, but the cumulative impact may be more limited. We stay risk on. Wade joins us now for more. Wade, good morning.
Good morning.
Can I pick up on that line? The cumulative impact. How are you measuring that?
Well, there are two potential templates that we can mirror what's happening right now. One is COVID, the pandemic. You switch off and you switch on. But in your case, you're saying that you can switch off again and switch on again, but we're talking about kind of being able to switch it back on quite quickly. The other template is Brexit, where you have multiple kind of years of cumulative scarring, where you have the economy below trend even today. So right now, given how quickly we have seen walk back, maybe the COVID type of template is appropriate in terms of structural scarring, but we're already seeing some sort of contraction, and I think technical contraction in the future is not off the cards, it's not off the table, but chances have been lessened because of the immutable law seemingly at work to guide the destination of where we end up.
When you say we stay risk on, what does that mean in today's market?
It means positive on U.S. equities and corporates in terms of credit over U.S. government bonds. I think what we have seen so far this year, especially this week, is that greater uncertainty doesn't mean greater certainty of a bad outcome. People make false equivalence between the two, but there's a huge difference. So when we talk about kind of U.S. debt arithmetics, when we talk about supply chain dependency, this will govern how quickly decoupling can happen, if at all, which is why we were able to stay risk on despite elevated uncertainty in terms of policy making. I would also say, we talk about U.S. equities recovering year to date. U.S. equities more than recovering the drawdown since April the 2nd, but U.S. government bonds haven't. Term premium went from 35 basis points on April 2nd to 70 basis points. Dollar hasn't recovered fully. So there is something more exceptional about U.S. equities and U.S. corporates, and this is what we are focused on in terms of our risk-on strategy.
This is something a number of people have put up, have talked about, the fact that U.S. exceptionalism still lies with U.S. big tech, and it still lies with some of the mega trends as you've put them out there. It doesn't lie necessarily with the dollar and U.S. assets per se, just by virtue of the U.S.'s position in the world. I want to stick with tech. This has been a bet of yours and the sort of structural theme. Just on a tactical level, has the rally already taken back all of the bullishness that you feel? And for now, it feels like maybe it's going to take a breather, even with some of these deals going on in the Middle East?
Well, tech has taken the brunt of market correction since beginning of the year. We think that there is more to go. If you look at their guidance, they have all committed to their previous capex spend, if not increasing. Broadly, companies are guiding down their capex expectations, but for hyperscalers, they continue to be all in on AI transformation, and multiples now look a bit more attractive compared to compared to before the sell-off, right? So we do think that there is more to go. Now, the bigger picture, we talked about the walk back and how markets are kind of jumping on incremental positive development. But the bigger picture is that we're still talking about a landing zone or for U.S. effective tariffs, somewhere between 10 to 15%. That is still 5 times more than the levels at the beginning of the year. And everything considered, we're still talking about an environment where we have higher tariffs, potentially lower growth because of that, and potentially higher inflation because of that. So I think that big picture is important to bear in mind as we think about portfolio construction. And I think markets jumping just to incremental positive news development is a typical case of behavior buyers of anchoring. We just look at kind of the incremental pieces, but the big picture has, tariff represents a stagflationary shock, and we still have higher tariffs compared to before.
Which speaks to sort of the divergence between tech exceptionalism and the rest of the universe. And I just wonder how pressured the rest of the universe of stocks you see as really feeling, especially if you do see potential risk to government bond markets going forward.
Which is why we definitely prefer tech and financials that have been leading in the latest earnings season compared to the rest of the market, compared to small caps, for example. So we see tech as the drivers of U.S. exceptionalism in terms of U.S. corporates, and maybe the rest of the markets as passengers of U.S. exceptionalism wave. And especially at times like this, where we're still talking about higher rates, high for longer, central banks not able to come to the rescue of the economy as they were before, we still want to focus on companies that can grow their margin, that can grow their profitability. And if you look at the latest earnings season, and also previously, tech and financials remain those sectors that we want to focus on.
What happened to the European trade? Where is it now?
Well, we closed the European underweight to lean into the European trade, but we're just neutral, not positive.
What's holding you back still?
What's holding us back? Well, what we have seen so far, if you look at the rally back from the lows post April 2nd, is that the outperformance of Europe over US has stopped. US started catching up now, and if you look at the hoops that MERS has to jump through to get confirmed, there remains risks around implementation of all these ambitious policies and reform targets. So we do want to see more kind of clarity around the ambitious targets for us to be positive across the board. But we have liked European financials for a long time that have been outperforming. We also see opportunities in defense as a sector, given the future spend and lack of capacity in that space. So being selective on European equities, definitely seeing a lot more opportunities compared to beginning of the year, but the market has come a long way. So I think one thing that we have seen so far is reversal strategy as a near-term way of navigating market volatility has worked, and right now reversal strategy seems to support US.
There's this reason why people are sort of saying pause to Europe. Just want to finish up with China. Do you think that there is more to go there, given the fact that seems like there isn't a full-scale decoupling, and it does appear to be supported by some fiscal as well?
Well, we're also selective in China. We're neutral more broadly across the Chinese equity market, but we like technology in China because of the innovation potential, as well as China tech potentially going a bit more globally. And we also like financials in China because of the national team's support, as well as funds closing their underweight. But the reaction of Chinese market to the latest development has been somewhat mixed, because the more we see kind of progress on the trade front, the less likelihood there is for more support on the policy side to come through. So now there is definitely a positive momentum in that previously people are talking about maybe 3 handle for Chinese growth this year because of the tariffs implication, but now people are very quickly upgrading their forecast for Chinese growth this year. So selectively opportunistic and positive on Chinese equities is our near-term tactical view. But over the longer-term structural constraints around kind of aging population, lower growth, that hasn't changed.
So those estimates revised higher to closer to 5% already this week. Well, it's good to see you, as always. Thanks for dropping by.
Thanks.
Wei there of BlackRock. Equity futures on the S&P turning positive, higher by a little more than 0.1%, with an update on stories elsewhere this morning. With your Bloomberg Brief, here's Yahara. Hey, Yahara.
Hi, John. Not positive. Our shares of American Eagle Outfitters, those are down 12.5% in the pre-market. In a preliminary earnings release, the company said it expects revenue to be down nearly 5% compared to a year ago. The retail clothing chain also pulled its guidance for the full year due to, quote, macro uncertainty. Meanwhile, Jaguar Land Rover has joined other car makers in withholding profit guidance due to the uncertainty caused by President Trump's tariffs. The British auto giant, owned by India's Tata Motors, says it's evaluating the impact of global challenges and will provide an update during next month's Investor Day. And trading and investment platform eToro has raised nearly $620 million in an upsized IPO. According to a statement, the Israel-based company sold nearly 12 million shares at $52 per share. The pricing marks a major rebound after eToro had paused its listing last month amid tariff-related volatility. eToro shares are expected to trade on the NASDAQ under the symbol ETOR. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara later this hour. Up next on the program, jet fuel for the U.S. economy.
This bill will get to the president's desk, and we hope to do that at least by July 4th, if not sooner. We believe this is going to be jet fuel for the economy. It will also send a very important signal of stability to the bond markets and the stock market.
Up next on the program, Tobin Marcus of Wolfe Research, live from New York City this morning. Good morning.
politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
What is going to be the consequence for U.S. markets?
We're basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
The president in yesterday's session, the Fed must lower rates. He won't like what he's hearing. On Wall Street, a lot of banks, Citi, Barclays, JP Morgan, pushing back their call for the first rate cut. Goldman going all the way back to December from the summer for that first rate cut for 2025 from this Federal Reserve. This market, though, not interested in that. This market interested in deals in the Middle East for chip makers. This market interested in a trade truce between the US and China. Equity futures up again this morning on the Nasdaq by 1/3 of 1%, on the S&P by more than 1/10 of 1%. Under surveillance this morning, jet fuel for the US economy.
This bill will get to the president's desk, and we hope to do that at least by July 4th, if not sooner. I think in this bill, what we'll do to extend the Trump-era tax cuts is going to be critical for the economy. We believe this is going to be jet fuel for the economy. It will also send a very important signal of stability to the bond markets and the stock market to let people know that Congress is on the job.
Here's the latest this morning. The House Speaker, Mike Johnson, working to get President Trump's big, beautiful bill over the finish line. Johnson suggesting that Republican lawmakers will likely reach a deal on the SALT cap today. Bloomberg's Tyler Kendall joins us now for more. Tyler, welcome back to the program. Just describe what that compromise might look like.
Yeah, hey, John. Well, it's going to depend on a few things. The current proposal on the table would lift the SALT cap from $10,000 to $30,000, phased out with income limits. But these Republicans from these high tax states like New York, New Jersey, California say that's not enough to ease the tax burden on their constituents. And they're threatening to sink the entire reconciliation package over this one issue. For context, they came into this week looking for that cap to land somewhere closer to about $62,000. So there's a pretty big gap there, but there does appear to be a way out of this, which is that the House tax bill is currently pricing in at about $3.8 trillion. We know that House Republicans were given about $4 trillion to work with here, which would suggest that there's perhaps $200 billion worth of wiggle room. But at the same time, fiscal hawks, of course, have been trying to find savings where they can. There's a few different areas to look out for some other compromises when it comes to SALT. Perhaps we could see a doubling of the cap when it comes to married couples. That's something that would be considered widely popular. And then another thing is expiration dates. So perhaps they will lift that cap higher, but then it just won't stay on for so long. The one thing important to keep in mind here, though, is that these Republicans really do have leverage because House Speaker Mike Johnson has such a slim majority. And John, these are Republicans that represent battleground districts in blue states, and they say they're really digging in.
They've got to fulfill a promise, that's for sure. Tyler, thank you. Tyler Kendall with the latest down in Washington, D.C. They've got an aggressive timeline as well. Tobin Marcus of Wolf Research writes this: despite a bumpy road ahead, we still expect the final bill will be enacted by July. Tobin joins us now for more. Tobin, welcome back. It's good to see you. Let's get to that aggressive timeline. What gives you the confidence we can get this all done, wrapped up, passed by July?
So there's a very hard deadline at the end of July, which is the twin occurrences of the August recess, when these guys are going to be out of town for an entire month. They tend to be very keen about getting out of town. And even more importantly, the debt ceiling X date, which is likely going to fall sometime in August. That is a quite immovable deadline, as opposed to some of the symbolic or aspirational deadlines around getting it done by this recess or that recess. So July 4th, as Speaker Johnson is alluding to, I think is ambitious, but not totally unrealistic. The end of July, I think, is a harder stop.
So, Tobin, what does this bill look like if they do get it done in your timeline, and how widespreading is it with respect to getting some of the campaign promises implemented?
I think they're going to be able to deliver on some version of most or all of President Trump's main campaign promises. They have in here now short-term versions of no tax on tips, no tax on overtime, something that checks the box on no tax on Social Security, although it's not exactly that. On the business side, we're going to get bonus depreciation, R&D expensing. They have this new structures expensing provision that kind of has supplanted the original idea for a 15% reduction of the corporate rate on U.S. production. So I think they're going to be able to check the box on much of that. The harder questions are on the offset side. Still ongoing debates about Medicaid. They put in quite sweeping, though gradual rollback of IRA that, in line with our views, looks like it's been pretty tolerable for markets. But it does seem like the pieces are falling into place on most of what they set out to do.
Tobin, what have we learned in terms of just how much, as Anne Marie would say if she were here, President Trump is sort of chief whip? He is the one going around and getting people to support and line up behind this bill. Do we have a sense that that clutch is still very much present?
They haven't really needed him yet in that closer role in the House process. I think they probably still will. We are still seeing, simmering concern about Medicaid, for example, from both the moderates and the conservatives. I think that they may need to bring him in to lead on one or both of those groups of folks. For example, if they do take the SALT numbers up to appease those blue state members, that's going to make the deficit situation look a little bit worse. There are already concerns about that on the conservative side. So I think if you're trying to get those folks on board, keep them in line as the bill gets a little bit less fiscally responsible. That, I think, is going to be an important role for the president.
Tobin, we know a lot about the SALT lobby. We've talked about them tons over the past few weeks. Who are the hawks in the Senate that we need to focus on in the weeks to come?
So from a spending perspective, Ron Johnson has kind of put himself out there along with Rand Paul, who I think most folks are figuring are not going to end up voting for it, Senator Paul, as saying, we need more spending cuts. This needs to be a more fiscally responsible bill. I think those were points well taken because a lot of the strategy for managing the cost of the bill is to rely on timing gimmicks. So both those individual and corporate tax cuts that I was running through, most of those expire in 2028 or 29. By our reckoning, extending those for the full decade, as we all expect that they will try to do, adds another $1.2 trillion in cost to the bill. So quite substantial. This is not really a bill that tackles the deficit, and it's stimulative in the early years. And then they're also going to be pinched on the moderate side. Senators Collins, Murkowski, Hawley have all raised concerns about the Medicaid reduction. There are various folks, including Senator Capito in West Virginia, who've been concerned about how far some of the IRA rollback provisions go. So, as in the House, I think there are going to be a lot of different vectors of concern and people nibbling on different axes.
Tobin, just before you go, we're getting live pictures of the president disembarking Air Force One. He's just touched down in Doha. Foreign policy has become increasingly a focus of this trip to the Middle East. Tobin, all these promises over foreign policy deals, can you talk to us about defense spending? Just how big is that push going to be? Where are the cuts?
So, the answer to where are the cuts in general on all of this, I don't think that the deficit is really going to be a focus to the extent that some of the rhetoric would suggest. The president's budget proposal calls for, sort of flat discretionary defense funding, a big tranche of defense funding through this reconciliation bill, and then big cuts in non-defense discretionary spending. I don't think they're going to get non-defense cuts. That needs to be done on a bipartisan basis, and they're not going to have the votes for that. So I think mostly we're looking at, kind of flattish funding along with this big new infusion of defense funding in the reconciliation bill. Deficits are not going down. They're not going to hit Secretary Bessent's 3% target. Mostly they're going to deliver on their other policy priorities and let the fiscal picture shake out where it does.
Tobin Marcus of Wolf Research. Tobin, thank you. Those pictures coming live from Doha as the president takes the next leg of his trip in the Middle East. The next leg focusing on potentially foreign policy and more.
Which potentially could be the next leg upward if there are some deals struck, in particular the war with Ukraine and Russia.
Futures right now positive by 0.2%. Up next, we'll get you a read on the U.S. consumer with Holly O'Neill, the president of retail banking at Bank of America. From New York, this is Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Nvidia up again in the pre-market, this time by more than 3%. Just adding some weight to this rally, adding some weight to a major rally off the low. The closing low on April 8th, we're up by more than 24% since then on the Nasdaq 100. The Nasdaq 100 this morning positive by 0.4%. The S&P up by a quarter. With 2 hours until the opening bell, with your morning movers, here's Danny Berger. Hey, Danny.
Hey, John, I got to say, it's not just NVIDIA. It's really any of these AI companies that have had a whiff of a mention in U.S. and Saudi deals. Supermicro one of the biggest beneficiaries of that. It's up 16% pre-market. It was also up 16% yesterday. The gains keep on coming. For this company, it specifically struck a deal with a Saudi data center company called DataVolt, saying it would be a multi-year partnership, that Supermicro would help supply some of the servers for it. The company has been struggling, so this is a big turnaround for them. We also had some sell-side action, specifically coming from Morgan Stanley, that seems to be shaking things up this morning. It gave a double downgrade of CBOE, saying that normalized relationships, or at least thawing of the tensions between U.S. and China, happened bigger and sooner than they expected. So defensive stocks that did well during the market turmoil, i.e. an exchange that does better when volatility and options are being traded, now isn't going to do as well. So they have downgraded CBOE, those shares falling 1.5%. Now, for a very similar reason, those analysts at Morgan Stanley also upgraded KKR. A more normalized capital markets environment means that private capital can do well, that deals will be getting done, one hopes, in a more normalized macro environment. Those shares up 1.8%, also saying that it's an attractive entry point considering that those shares have sold off this year, John.
Hey, Danny, thank you. Appreciate the update. Just an update on our programming tomorrow morning. Jim Zelter of Apollo. Jim Zelter a number of weeks ago talked about so-called macro paralysis. And I wonder about that macro paralysis theme now after the events of the past week.
Is it macro deal making? Is it essentially the paralysis released, cured, as people try to get to the playing field and really strike up some deals?
Look out for that interview tomorrow morning around 7 a.m. Eastern Time. On our radar this morning, President Donald Trump landing in Doha for the next leg of his trip to the Middle East. Trump expected to participate in a Qatari state dinner later on today, and that destination is playing a bigger and bigger role. You talked about it in foreign policy.
Yeah, especially given what's going on with Israel and Gaza and what they've done in terms of negotiating some of the release of hostages. On the way there, how much is he going to make a stopover in Turkey at the same time to really discuss what's been happening between Ukraine and Russia and brokering a meeting between the two leaders? Here's a question. How much does this really solidify this region's instrumental role, both on a foreign policy level, but also at an investment policy? And you point to the fact that tech stocks are surging and they're taking another leg higher pretty much across the board, partly because it is clear that there isn't the same kind of discrimination against some of the more friendly nations when it comes to chip sales as there is to, say, China.
I'm pleased you brought up Turkey. I think that's potentially an important meeting tomorrow. As far as I'm aware, we still don't know who's in the Russian delegation. And I think I get the sense, and others do too, that who is in the Russian delegation will dictate whether the president actually goes to Turkey to be a part of these talks or not.
If it's Vladimir Putin, yes. If it's not,
something
no.
like that.
Something
like
very
that.
similar, very simple kind of cheat sheet. That's kind of what people are looking at. It is going to be curious to see how serious these talks actually are about ending that conflict that has killed so many people.
It's been depressing, awful, that's for sure. Elsewhere, we've got to return to the markets and talk about what's happening here stateside. Equity futures, as Lisa indicated, are near session highs off the back of these moves that we've seen in chips. But one thing that hasn't fully recovered is the US dollar. If you notice, the South Korean won has been climbing. Sources telling us here at Bloomberg that South Korea and the US discussed currency policies early this month in Milan, with an agreement to continue talks on operating their FX markets. Now, this is interesting. We had a conversation just moments ago with Exante Data's Jens Nordvik, and Lisa asked him an important question. He was reflecting on this dollar long that's been built up over the last decade and the potential for a reversal. And the fact is that that move might be welcomed by this administration, and our reporting would, I think, to some extent speak to that.
If you have a weaker dollar, you can increase your exports in a more consumer-friendly manner. It is cheaper for other countries to export from the United States. So there is this theory that maybe this is what this administration wants, especially as news comes that they are discussing currency manipulation as part of the trade discussions. Can I just say, this feels a little bit like a Festivus-style airing of the grievances of, VAT tax and currency manipulation and chickens. I mean, it feels like that pretty much around the world. And when it comes to South Korea, they did intervene in their currency last year, late last year, when the dollar was surging. Here's a question, though. What is the ultimate goal? Is it just to normalize the trade relation? At what point does it get too weak? This is going to become on your dashboard, maybe, of headlines to watch and ranges to look out for.
Yeah, this is part of our reporting, and I'd like to hear them talk about it on the record to see what the ultimate objective actually is. Now, Lisa mentioned this yesterday, that this market has potentially been reduced to just monitoring the social media account of the President of the United States, and Goldman did some research just for Lisa. President Trump likes US oil prices between $40 and $50 a barrel, according to Goldman Sachs. The firm analyzed his social media account, finding he has posted nearly 900 times about oil and US energy dominance.
So this is the new model, evidently. The inference about preferences that this president has, and you mentioned earlier, John, I wonder what that inference would be for the Fed policy and what exactly triggers him to start jawboning the Fed. But this highlights two things. Number one, how important oil really is, raising questions yet again about the increase in supply from the Middle East ahead of some of these negotiations. But then there's a second question. Is this the new dashboard? You talk about economic data. Is the new dashboard true social posts that you can then somehow calculate, get a sense of getting into the mind of the president, and then getting ahead maybe of some of the headlines that have been jerking around this market?
I'll let others do the psychoanalysis of the president regarding a social media account. It has been reduced to the entire market. I agree with you. It's been reduced to just tweets and headlines regarding trade. His point on gasoline, though, is real, and he's right. Gasoline prices have been falling, and that helps set the tone for the consumer. So let's turn to the consumer. Retail earnings ramping up, with Walmart reporting on Thursday, offering another read on the US consumer. The team at Bank of America writing the following: spending momentum remains, though it's moderating. Consumers appear to be pulling back, particularly on bigger ticket discretionary services like airline tickets and lodging. Holly O'Neill is the president of retail banking at Bank of America. I'm pleased to say she joins us now. Holly, welcome back to the program. I want to talk a little bit about the consumer, and then we can get to what you're doing operationally. But let's start with the consumer if we can. What are you noticing, and how is that different to what we've seen previously over the past few years?
Well, the consumer appears to be continuing to spend. They're very healthy. And you had the headline. They spent in April at a rate of about 1%, and that's our credit and debit data. And that was just slightly cooler than they spent in March at 1.1% growth year over year. So they have momentum, but it's moderating a little bit. And I think the driver of that is that they're supported by continued wage growth. So we saw good wage growth in April, both in higher income and lower income, though it is moderating a little bit. So that theme is still healthy, but moderating.
Holly, I'm pleased you broke up the income groups, because we sit on that just for a beat. The low-income group have been squeezed for a while. We've seen that in data repeatedly throughout this cycle coming out of the pandemic. Do you see any stress going up to the upper-income cohorts?
No, so the lower income household wage growth, just to give you the numbers, picked up by about 1.5% in April, and that was stronger than March. So March was 1.4%. So that wage growth in the lower income cohort increased a little bit, and I think that wage growth is continuing to support the consumer and the consumer spending. When you get deeper into the data, some of the credit data, as an example, the lower income households are continuing to hold up. Overall, we've seen 30-day delinquencies come down a tad. So I think that consumer still is showing signs of good health.
This really raises a question, Holly, about how much we can really count on some of the soft data, which indicated an incredible amount of nervousness and pessimism among consumers in the United States during the month of April, in particular after April 2nd. Are you saying you're just not seeing it? That frankly, people can go out and gripe about how concerned they are about the future of the world, but then they go out in a spending spree?
We're not seeing it. And I think we often talk internally about, you have to separate what consumers are saying versus what they're doing, what we're seeing in our data. And that data is telling us that they're continuing to spend, although it is moderating. And so we saw in April, restaurants, good spending there, but we did see a dip down in airline and lodging, leisure travel a little bit. So consumers are adjusting slightly, which leads to that, the momentum is dipping just slightly, but you really do have to separate what consumers are saying in many of the confidence and sentiment numbers versus what they're doing, what we're seeing in our data, whether it's spending data, payment data, or credit data.
Holly, I want to congratulate you. You have basically just received a pretty big promotion. You're running much more of the consumer bank, and you come at a time when there's a real question around how different the scenario is in different parts of the United States, how it's not a monolithic story at all, and how different regions are feeling very different realities depending on what their local economies really depend on. How different is the scenario that you're looking at in the United States right now, depending on which region you're in?
So we obviously have across the country footprint. We have 3,700 financial centers in all of these local communities. So, our goal is to really deliver for our consumer clients, approximately 70 million of them, uniquely to what their situation is, whether that's geographic or that's individual. So, we are there to adjust and course correct based on what our clients are telling us and based on what they need.
Holly, how are the interactions changing between customers? How different are they now? And how does that change what you need out of your physical footprint?
So our strategy is all about physical footprint supported by digital. And it's really the combination of the both that I think lead to the power of how we can deliver for the consumer client. So those 3,700 financial centers in local communities, coupled with world-class digital capabilities. Those digital capabilities continue to grow, they continue to advance, and consumers love them. At the same time, it does not substitute for face-to-face interaction that we get in our financial centers when a consumer client really wants advice and guidance in their financial position. So it's the combination of the two that I think really deliver the power for our consumer clients.
Holly, how much have you been able to expand the physical footprint, in part because of the turmoil that happened? It feels like 10 years ago, but not that long ago, I guess March 2023, in terms of some of the regional banking turmoil. How much of this has just accelerated since then as you look to take market share?
So we continue to expand into new markets. We continue to build new financial centers in communities where we need them. So we will continue to advance that agenda across the country. New markets. Idaho is a recent new market that we've entered, and we've got more coming. So we will continue to expand in new markets. We'll adjust our footprint in existing markets, opening new financial centers. Over the last decade, we've opened roughly more than 200 financial centers. And as we look forward, we expect to continue to open 150 more over the next 2 to 3 years.
Holly, I was dead wrong about all this. I thought as we change these interactions, we'd end up with a smaller footprint, that it would give banks a reason to cut costs and reduce their physical footprint. Holly, why is that not happening? And is there space for that to happen in the future?
Yeah, no, you're not wrong. It has happened. If you look over the last decade, we started with 6,000 financial centers. We are down to 3,700. That may tick down slightly overall as we do things like consolidate, close 2 financial centers in a local community and open 1 new financial center. So you will continue to see at the margins some reductions, but that physical footprint, that engagement with our clients in their local community is incredibly important as a complement to the digital reach that we have with our clients.
Holly, appreciate the clarity. As always, it's good to catch up. Holly, I know there of Bank of America. Whenever we catch up with Bank of America, just a direct read on the consumer. No politics, no bias, nothing. Just this is what's happening, this is what we're seeing. And what they're seeing is still okay. Some resilience.
They didn't see any translation from that soft data into the actual behavior of consumers. This just goes to the angst that people have of what can they rely on as a sense of exactly the real-time response of consumers and of corporations.
If you are just joining us, welcome to the program. Equity futures here near session highs, up 0.25% on the S&P. Chip makers doing nicely, and Nvidia up in the pre-market by something like 3%. With an update on stories elsewhere, with your Bloomberg brief, here's Yahara with more. Hey, Yahara.
Hi, John. President Trump says the luxury jet being gifted to him by Qatar's government will be used as a temporary Air Force One. Trump said it would be foolish not to accept the jet, which he says will save the U.S. hundreds of millions of dollars. The offer setting off alarm bells within the U.S. intelligence community, where gifts from foreign powers have long been viewed with suspicion. Meanwhile, Harvard has expanded its lawsuit against the Trump administration for freezing billions of dollars in federal funds. Harvard claims that federal agencies illegally halted funding because the university refused to submit to government control over its academic programs. Yesterday, the Trump administration cut another $450 million in grants to Harvard. And baseball's all-time hits leader Pete Rose has been taken off MLB's ineligible list, qualifying him for Hall of Fame induction. Rose, who died last fall, had been banned since 1989 after he was found to have placed bets on games as a player and as a manager. MLB Commissioner Rob Manfred said he met with President Trump earlier this year where the two discussed Rose's situation. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on the program, appeasing President Trump.
I think the Fed's going to be in a good position to cut a few more times. That could appease Trump, because really what was holding them back, you can't cut when there's 145% tariffs, where no one knows where they're going to go in the globe right now.
Up next on the program, the former New York Fed President, Bill Dudley. Live from New York, you're watching Bloomberg TV.
In case you missed it, on Bloomberg Open Interest, how much would it cost to bring production here, Rebecca? I mean, what kind of upcharge would you be looking at?
There is no handbag infrastructure in America anymore besides a couple of small factories in New York City. So not only would we have to build a factory that could make the amount of units we're trying to make, but we'd have to bring back hardware manufacturing, bring back tanning and leather. I mean, these are all things that are purchased overseas and assembled. You know, if you want this to really work, Give us grants to build factories, give us several years of tariff breaks in order to make these things happen, and then we'd love to make in America. It just right now, if I were to switch everything to America, my price would double, and my consumer is not here for that. As small businesses doing under $50 million, keep us alive. We are employing millions of people collectively and affecting livelihoods across the U.S.
Don't miss Open Interest live weekdays.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Middle East and Africa, vibrant resources and high